Good morning, everyone. Thank you so much for being with us here today. My name is Tom Burgandy, and I am the chairman of the board of CFA Society New York. Really excited to host this event today, and I want to thank a number of people. Hubert Danso, Karen Svensson, our colleagues at the United Nations DESA. Also want to thank folks who've traveled from far distant places to be here today. So also want to thank our speakers, of which we have many, and just really grateful that everyone is here today. Also, apologies, also want to thank our sponsors, MSCI, S&P, and also Gabriel's company. So at this point, I would like to bring up a friend of mine from the family office community who will introduce our first panel, Camille Holmesy. Camille is a dear friend for a long time, and he is definitely a leader in the family office community. So Camille, come on up to the stage, and we will begin the program. Thank you.
Thank you. Good morning, everyone. This is my second time in this building in my life. Last time I was sitting somewhere there. So I figured after speaking to Tom that the best when I attend or speak at a room where everybody is smarter than I am, that I reach out to ChatGPT this morning and I said, what should I tell them that they do not know? And then ChatGPT said the truth. She or he said, I only collect data, I do not create data. So that's what we tell Gen Z when we speak to them and we say, don't rush with that AI, let it take its due course. My name is Camille Holmesy and I run the GRC Investment Group. We are a single family office headquartered in Dubai. We are in our third generation. We are global investors with a focus on alternatives and mainly on commercial real estate, on renewable energy, and on waste management. We do have smaller buckets of investments. I am told not to take more than 3 minutes, so I'm going to cut my life story and stop here to tell you that fast forward 2014, I developed an overarching policy where I put deeper focus on my due diligence when I engage in co-investments or indirect investments on the topic of ESG principles and on its implementation. I call ESG as a conscientious investing. No one is twisting your arm, coercing you to invest into it. If you are from the school that follow Milton Friedman, what he said in 1970, in that essay that he wrote to the New York Times, where he placed the responsibility on you that your duty is to deliver return for your investors, and what they do with the profit is their prerogative. If they want to spend it in Atlantic City, in Vegas, or if they want to place it into a project that can create an impact. Among other definitions I use frequently, that ESG is only the tool. Impact is the outcome. Many people say, oh, I invest in impact. I say, where do you start from? So all that being said, today's conversation definitely blend ESG with, what did ChatGPT say? Wow. It said that in business today, blended finance is becoming the norm when you structure a capital stack. We all know that blended finance today is the main vehicle that most of the larger projects need when they are structured. As we bring in different entities that have different goals, different expectations, and different level of tolerance that they can tolerate. At this point, without any further ado, as I'm getting signals from the back, I should stop and introduce the gentleman who will be moderating the first panel, and that will be Mr. Krishnan Sharma. If Mr. Sharma is here and can come to the stage, Mr. Sharma, I see from the names on your panel, your esteemed panels will be also here, I'm sure, to join you. Thank you very much, everyone, and I will enjoy being with you here most of the day. Thank you.
Thank you very much to all of you for attending this panel on what does blended finance need to fill the sustainable investment gap or the sustainable funding gap. By way of introduction, I'm Krishnan Sharma, and I work for the Financing for Sustainable Development Office in the United Nations Department of Economic and Social Affairs. An important assignment we have in this office is to support the work of the Global Investors for Sustainable Development Alliance, which is a coalition of business leaders and institutions who were set up by the UN Secretary General to find solutions to scaling up finance and investment to advance sustainable development, and in particular, to achieve the UN Sustainable Development Goals by the year 2030. Now, achieving the SDGs and advancing sustainable development in general would require trillions of dollars of investment per annum. Investment in critical areas like energy, water, health, education, transport, telecommunications, and so forth. And in fact, estimates have suggested that you would need as much as $4 trillion per annum if you are to achieve these goals by the year 2030. Where will this money come from? Public finance is important, but clearly not sufficient on its own. There is a critical need to scale up private investment, especially long-term private investment for sustainable development. The problem is that private investment to date has also been insufficient. If you look at clean energy, for example, the annual investment needs have been estimated at around $1.7 trillion, yet they only came to about $500 billion last year. So there clearly is a big gap here. And it's in this context that blended finance has been presented as a solution to help fill this funding gap. Blended finance, which involves concessional public finance in a role that catalyzes and leverages additional amounts of the private finance and investment necessary to fill this funding gap, be it through co-investments, be it through risk sharing, risk mitigation, and a number of different strategies. And blended finance, in fact, has great potential. I mean, to date, if you look at where blended finance has gone, about 28%, in fact, has gone into clean energy, about 22% into financial services, 21%, in fact, into the area of agriculture, broader infrastructure, and so forth. So it does have great potential. But if we were to be honest, it hasn't really fulfilled expectations in different respects. Firstly, in terms of the amount of finance that it has really mobilized over the last 15 years or so, these come really to about a few $100 billion, nowhere near the trillions of dollars per annum that we need. Secondly, I mean, there have also been concerns about its skewed distribution, where it's flowing to. The large sum of blended finance has flowed to middle-income countries and emerging markets. The poorer, less developed countries have really not benefited from this mechanism. Just as worryingly, there could be an issue even of adverse selection in terms of the fact that the projects which have been sort of receiving blended finance have tended to be low-risk projects. I mean, and some of whom have a limited development impact. And so it's not really fulfilling that role of additionality. It's going to projects which the private sector may have financed in any case. And more broadly, if we are to look at blended finance, I mean, it's very important that it's aligned, in fact, with sustainable development in the broad sense, in terms of project selection, I've mentioned, in terms of the transparency and accountability behind the deals, in terms, very importantly, of fair risk sharing between the public sector and the private sector. I mean, it's very important that you get that right balance, and in terms of meeting social and environmental standards. Now, if all of this sounds very sort of, how do I say, sounds like a lot of caveats, let me say that, we think blended finance has tremendous potential, and the Global Investors for Sustainable Development Alliance, the GISD Alliance, has in fact been advocating for scaling up blended finance, albeit under the conditions that I've mentioned. In fact, it sees the multilateral development banks as having a particularly important role here, where they can sort of, and it has formulated recommendations where the MDBs can really sort of advance blended finance and catalyze it. At the same time, the GISD Alliance is also working on a transformative blended finance fund, which aims to combine institutional investor capital with co-investment from the MDBs. So we see this as an area with great potential, but there are challenges which needs to be overcome, which brings us, in fact, to this particular panel. I mean, which will look at, what are the challenges, what is the landscape, and how can we move forward in really ensuring that blended finance fulfills its potential. So without further ado, I will move to our panelists, and I'd like to ask them if they could kindly introduce themselves very briefly. Beginning with you, Emily, please.
Yes, good morning, Krishnan, and good morning, everyone. I'm Emily Mutambasere. I work as the manager for development impact in the unit at IFC that looks at the portfolio in manufacturing, agribusiness, and services. Many years of experience working on private sector transactions, and had the privilege of helping to lead in the design of the framework that IFC uses to establish the economic rationale for its blended finance investments. I'm very glad to be here and look forward to the discussion.
Good morning, all. Thank you all for putting this event on and for having us here today on a very important topic. My name is Dr. Nnamdi Ibokwe. I'm the Director of Knowledge and Thought Leadership at Convergence. Convergence's mission, really, as the global network for blended finance, is to do three things. First is to create data and intelligence around blended finance to create the evidence base to continue to push forward the ecosystem. Second is to facilitate deal flow through our membership network and also our live deal platform to connect funders and those seeking capital. And third is market acceleration through our design funding arm, where we offer grants for proof of concept and early stage funding structures. But we're focused on the reality of de-risking to create assets to meet the fiduciary requirements of the private sector so that we can increase their participation in order to address the SDGs and climate. So to date, we have about over 1,000 deals in our HDD that's mobilized in total nearly 200 billion. So continue to do the work to expand the understanding of blended finance, and happy to see that it's no longer seen as a cottage industry, and it's now seen at the forefront of a tool that we can use to sort of address the challenges that are ahead of us. Thank you.
Good morning, everyone. My name is Yana Watson-Kakar. I'm the Managing Director and Head of the Americas for CDPQ. And CDPQ is a Canadian pension fund with 400 billion in assets under management, Canadian, that manages the money for the people of Quebec. We are also very active in blended finance, and as members of the Global Investors for Sustainable Development, the Investor Leadership Network, GFANS, and several other acronyms. We are strong proponents of blended finance, so I'm really delighted to be with you this morning and talking about how we can accelerate progress.
Hi, my name is Jay Collins. I'm a Vice Chairman of Banking at Citi, and I cover governments and developmental institutions. I'm also a proud member of the steering committee of the Secretary General's GISD.
Great, thank you very much. And we'll now embark on a roughly 40-minute panel discussion on the issues, following which hopefully we'll have time also for an interactive sort of engagement with the audience and the panelists. So beginning with the first question, what is the potential for blended finance? What are the conditions under which it is most effective, and why should it be avoided? I'll begin by posing that question to you, Nnamdi.
Thank you for that question, highly important. Well, you mentioned and alluded to in your intro the immense potential of blended finance. Historically and conceptually, it's really been a tool looked at to address some of the world's most pressing problems. It depends on catalytic capital. It depends on the structuring mechanisms of blended finance. Maybe I'll answer that question in part by starting with the why, how, and where of blended finance. In thinking about the why, the development finance ecosystem has shown an inability to really meet up to these targets. We always talk about billions to trillions. We know that the funding from a public perspective is not there. So the private sector is necessary. The issue with the private sector being necessary is fundamentally, there really is no investment thesis that makes sense to enter these emerging markets and developing economies. The risk-return profile just doesn't add up. So that's one hurdle in terms of understanding the why. More currently, certain macroeconomic shocks and issues around foreign exchange risk, currency risk, country risk, has created a redirection or a retreat of cross-border capital. So what that has caused is these areas that already found it very difficult to attract private sector capital in the first place are now deemed as even more risky. The risk-return profile has actually increased. Most of the median, I would say, risk rating for African countries is CCC. So inherently, there is sort of a version of going into, at least from the debt perspective, going into these markets with investment opportunities. So in principle, blended finance is looking to bend the economics, so to speak, disproportionately towards the parties that need a commercial return, while also allowing those parties that want an impact or development outcome to achieve that goal. So that's the why of blended finance. As far as the how, just quickly going through different archetypes that we designated convergence. Concessional capital, which is used to protect a layer in the capital stack, either first loss or subordinate. Guarantees as a credit enhancement mechanism. We have technical assistance facilities, which is to improve capability, capacity building, and also design funding, which I mentioned in the intro, to accelerate market design for transactions. Also from a vehicle perspective, these funds are typically deployed in projects, portfolio of funds, or an aggregation of portfolio of funds, or directly into companies. But if we think about the where now, regionally, Sub-Saharan Africa leads in terms of areas where blended finance is seen, 48%, followed by Latin America and South Asia. Sector-wise, the energy sector, financial services, agriculture, those are the top three. Projects range anywhere from 110,000 to 8 billion, with the median being at about 64 billion. So you also asked what's the most effective conditions. A few of them. Number one, the intention has to be to mobilize private capital if you're using a blended finance structure. Number two, it should be anchored in development rationale, meaning creating an impact in alignment with the SDGs or climate. And number three, it should be tailored to the local context and be context specific, aligned to the area in which these transactions are being produced. These are some necessary conditions, not necessarily all sufficient to equate a successful blended finance transaction, but these are some things that should be kept in mind. But I'll also note that blended finance is not a silver bullet of any sort. It's not a panacea. It's not an all-encompassing investment philosophy. It's actually a structuring tool. So as a tool, blended finance can mitigate risk. It can change that balance of the risk-return profile to allow the private sector to meet their fiduciary mandates. But what it cannot do is cover up for a business model that fundamentally fails to capture economic value. So we always say, you start with the problem and see if blended finance is an absolution in terms of a structuring tool to address that problem, as opposed to taking blended finance as an umbrella sort of approach and trying to attack every single thing with blended finance. There are certainly instances where it applies, but there are also instances where it may not apply. And you mentioned in renewables, for example, you might have private sector participation that might have existed without blended finance, in which case markets might get distorted in that sense. So always approaching the problem and then seeing and assessing if blended finance is a solution that makes sense for that problem.
Thanks very much, Namdi. And Emily, can we have your perspective, the IFC's perspective on this?
Yes, thanks, Krishnan. I think the previous panelist has already given a very macro, comprehensive response to this question. Let me give a little bit of a more transaction level response to this. So, starting with the why of blended finance, I think at IFC we look at two dimensions of why we think in certain cases blended finance might be needed. One is unlocking what we call participation constraints. And this has been said by multiple speakers already, addressing the risk-reward imbalance and making sure that the transaction that wouldn't have gone ahead is actually enabled to go ahead. Of course, the transaction has to be impactful, right? A second important one, especially for us, is changing behaviors in certain markets where we need the behavior of players to move in a certain direction, right? So, for example, incentivizing additional lending to SME finance from banks that have traditionally been players in these markets, but they have not done enough, according to our own judgment. The same can be true in an area such as climate. Another thing that we think blended finance can do is to help development finance institutions such as IFC to be able to bring to bear their additionality, right? So the way you can think about it is if a project that's potentially bankable that just needs that final push to get across the finish line, if it doesn't happen, it means IFC cannot bring to bear better lending terms for local currency financing, the non-financial additionality that it normally brings with it to deals such as better governance, environment and social standards, the technical assistance that it typically brings in the deals that it supports. So having blended finance enable other partners that have a development mandate to participate in deals is also another important role that blended finance plays. Directly or indirectly, sometimes blended finance also helps to solidify or enable reforms in many sectors. So what we've seen from a transaction perspective is a lot of projects that get blended finance are first movers of a kind. They are innovative investments. They are coming into a market where the regulatory or policy environment is not well tested. And so by helping those projects to illustrate to the market that this can be done, you actually solidify or enable the reform to take place. So another way of thinking about the how, and I like how you put it. So I think now in terms of the conditions under which blended finance should be used, let me again use a framework that most DFIs use because it was developed by DFIs, but it's also very transaction specific. There's a set of principles that DFIs have put together that are called enhanced principles for the deployment of blended finance. I mean, if you're not in the transaction space, this will be boring, but I think it's really, again, another set of necessary conditions that we look at on every transaction that we give blended finance. We look at 5 things. The first is the rationale there of an economics nature, right? The second is this condition we call minimum concessionality. Are we giving the project the minimum push that it needs? That helps to prevent the distortion of markets that the previous speaker spoke about. The third is long-term commercial sustainability. We don't want to be in deals that will never be commercially sustainable and use blended finance for these transactions. The fourth is reinforcing markets. I think that one is self-explanatory. And the final one is maintaining high standards. So I think these are sort of like a set of principles that when we're looking at transactions, we look at them and we think that they are important. I mean, beyond these principles, when you're deploying blended finance, there's also a need for the operational guidelines that support the implementation to be efficient and effective at achieving the outcomes that you're looking for. So some of the things that we think about on a day-to-day basis is how to make sure that our governance systems within IFC are designed in such a way that we exercise discipline in the use of blended finance. It's also making sure that we match the distortion that we are trying to address in these markets to the instrument that we are using. That helps us to avoid wastage, to throw money at a problem, hoping that something sticks. In terms of the areas where blended finance should not be used, I think some of them have already been stated. Let me highlight a few that I want to add.
Do it little,
Yes.
quickly, thank you.
Yes, 2 points. The 2 points I wanted to make is, I think it's important to think of blended finance as an evolution, right? The use of blended finance as an evolution. The instruments will change as the markets mature, and the level of concessionality will also change. And in markets where it was justified before, it may no longer be justified, or it may be justified in a different shape. So having those frameworks in place and being intentional about it is important to get the best out of blended finance. I'll stop there, Krishna.
Thank you so much. These are two rich and very complementary perspectives on that. And now we move to the point that both of you have made, which is about having appropriate risk sharing between the public and private sector, having fair and effective risk sharing. And here I wanted to first begin by drawing in a private sector perspective. Jay, I mean, what are your thoughts on this? How can we sort of ensure appropriate risk sharing between the public and private sector?
Thank you. Let me just ask you all just a quick question. How many of you are financial practitioners? Raise your hand. And how many of you, and I'm not going to ask you to do this, but just would feel comfortable standing up and saying, here's what blended finance is? Okay. Okay, so a reasonable number of you are still wrestling with what this is. So let me talk in those terms. You've heard this concept of developmental additionality and what we're trying to do to crowd the private sector into SDGs and climate. You heard the term capital stack, which essentially, as we think about it, is risk sharing that mixes the risk and the return of both the debt and the equity for any given project. You may not know that in the trillions of dollars in the world, let's just take the GFANZ monies, $130 trillion. When you say we need to drive those into the weakest credit countries in the world with a developmental prism, a purpose, additionality, why doesn't that group of investors take that risk? And the reason is after the financial crisis, we put regulatory constraints around banks and insurance companies so that we'll never have the financial crisis again, right? We regulated to say we won't do this again, such that those regulatory parameters and the pensions of the world, the largest pensions asset owners that many of whom are in this room, also have fiduciary responsibilities. And all that translates into parameters that equal investment grade risk. They're not, given their construct, able to take in emerging markets, let's say single B, double B type risk. And so in order to take that money and try and push it into developmental additional projects in the weakest credit countries in the world, we need to blend. And we used to talk about, prior to Addis Ababa, blending as a concept of taking developmental concessional money, so non-market priced money for debt, and blending it with private capital markets and their cost of debt, and we would blend that. And Addis Ababa added a new concept, which gets back to this capital layer, which is, okay, at the bottom of the stack is a need to really take risk. And we'll talk later, I think in the next session, more about the MDPs, but if you're going to take risk, generally risk is taken at the equity level. But equity demands generally quite a big return, private equity. And so we've added to this blending a concept of a loss absorption or a risk layer that will either have no equity return or a low equity return, or actually come in as a grant into that. And the reason this is so critical to why isn't this working faster, why aren't we scaling it, is if you don't have that risk absorption layer at the bottom of the capital stack of any project, let's just say 5%, to throw out a number, of grant money or low return, no return equity, to absorb the risk of the emerging markets, you can't layer on all of the other aspects of capital to make this work. And so one of the things we did in a GISD report early on is to say, we need more philanthropic money, we need more grant money, we need the ODA community, the official development assistance community, to blend more. I don't know if you all have any sense of how little that is, but right now, out of all the grants given by the official donors in the world, max they blend 2%. So think about it, is if you don't have that loss absorption layer, I can't then crowd in a junior mezz or a concessional financing and guarantees to then allow this massive pool of investment grade or global investors that have an ESG prism and that want to do these deals. But I can't really get there. And so then I say, okay, if I'm a grant organization, first of all, I'm not generally financially used to structuring. These structures are really complicated. In fact, to get bankers to structure a $20 million, $50 million project in the Congo, like, I have to say you've got to do that, because those bankers are trained to structure deals like that for billion-dollar deals, and those are complicated structures, and we're still doing these in very difficult places with very difficult capital structures. But importantly, the grant community that's generally doing that, if they don't have a banker or the MDBs by their side, it's very complicated. But more importantly is, if you think about it, the system is so used to giving a grant away rather than putting that into and trying to structure that into a blended structure. The system doesn't push that. And one of the recommendations, and I'll stop here and we can see if we follow up, my friend, with more questions, but I've said, oh, you all given a choice. You're a policymaker at CEDA or USAID. And I can give $1 to a country and have to give that dollar for the same additionality, developmental impact, again next year and the year after that. Now I have another choice. I can take that dollar, I can put it into an ongoing concern, a structure that creates an ongoing project for multiple years. I may get that dollar back, and I mobilize. And this is the key of blended finance. The whole point is to mobilize more than the public sector coffers allow us to do. And so that $1 can translate into, let's just say, 8 to 10 more, if I use that loss layer properly. So the grant organization might get that back, but most importantly, they will crowd in another, say, 8, 9, 10 into something that may allow an ongoing proposition that adds value over a multiple years. So which do you choose? Right now, the grant community is stuck continuing to choose grant. So we need that base layer of risk that right now at investment grade the MDBs can't take, or at least their shareholders aren't allowing them to take, to put that layer in, and we could potentially structure more. So I'll stop there.
Great, thanks very much. And Namdi, what's your perspective on this in terms of the appropriate balance of risk sharing?
Yeah, very, very key points that you're bringing up, and I'll try and follow up and buttress some of the concepts there. To start, I think we should...
So if you could all just keep it a little briefer, since there are a number of rounds of questions I want to, so everyone could just be a little briefer. No.
Of course. Just quickly remember that it's not the private sector's responsibility or job to solve development challenges, right? Development finance institutions and governments have to make sure that the environment is conducive and optimal for their participation. So that's the first thing. And these institutions were never really designed to mobilize the private sector in the first place. They were just in the business of giving grants. So if we think about this capital stack and we think about leverage ratios, Convergence put out a report on leverage ratios saying that for every dollar of concessional money, you get and mobilize $4 of commercial capital. We did a revisit to the study from 2018 and 2023, and that ratio has stayed the same. And what that means is, even in that $4 ratio, half of that is commercial capital, half of that is private sector capital. So MDBs and DFIs are continuing to not operate at that lowest layer of risk or that lowest layer of concessionality. In fact, our research shows that their participation in the concessional layer is probably the most minimal, even though they're funding at the most high levels. So if we understand that stack, we have to make sure, or MDBs and DFIs need to make sure, and this starts with governance from their shareholders, that they are operating in a way where they're not fighting for senior positions. They're not mobilizing themselves, so to speak. And they have to be able to take more junior positions, mezzanine positions, to allow for their capital to be more catalytic and provide more ability to mitigate risk and de-risk so the private sector can come on board in larger quantities and larger amounts. So they need to be more flexible with their capital. They need to have better collaboration and exit senior positions. And just a quick word about philanthropic capital as well. Very, very important component in blended finance. They are the most flexible, the most experimental, the most patient capital, and oftentimes we see their capital be the most muscular in terms of having a catalytic effect, especially when we're talking about sectors that haven't been explored, geographies that are still nascent. So it's very important to bring philanthropic capital on board in these transactions as well. But I'll keep it at that so we can continue the conversation.
Thank you very much. And my apologies for rushing everyone along. This is such an interesting topic, in fact, and we're getting some great perspectives. And the point that both Namdi and Jay have made, of course, is the importance of, having is the role of multilateral development banks. And Jay, in particular, you mentioned that, we need to sort of have more blending. And you mentioned how small the percentage is. And in that respect, I wanted to move to the issue of what role can the multilateral development banks really play in advancing blended finance. But here I wanted to start by getting an investor's perspective from Yana.
Thank you. Yes, I think essentially what we're all saying up here in different ways is everybody has to play their position. And because whether it's philanthropic capital, private capital, public capital, we're blending together in order to address some of the world's most pressing problems and some of the most challenging economies of the world. But if we're not each playing our position, then you trip over each other and you don't move the ball down the field as fast as you need to. And that's exactly what's happening today. So the multilateral development banks, I think one of the challenges is that their business models and incentives are not necessarily aligned to focus on maximizing the total investment that goes into emerging economies. And that ideally would be what we would want to see MDBs doing, not maximizing their own investment into an emerging economy, but the total investment. And from the perspective of an institutional investor like CDPQ, as we've said earlier, the fiduciary responsibility that we have means that we really need our MDB partners to take a risk-sharing position, to play their position so that we can invest more capital into emerging economies at rates of risk that make sense for the pensioners we represent. And for that reason, actually CDPQ, as part of GISD, as well as several other investor-led initiatives, the Net Zero Asset Owners Alliance, the Glasgow Financial Alliance for Net Zero, or GFANZ, the Sustainable Markets Initiative, and the Investor Leadership Network, are actually currently sort of articulating or have articulated a short list of sort of key recommendations for the MDBs. And they are, I'll briefly summarize them. A, setting very clear and quantifiable targets for private capital mobilization. I'll just say that between 2018 and 2020, MDBs mobilized $34 billion over 2 years. And it's a big number, but it's actually a tiny number. That's just, it's nowhere near the levels we need. So set more clear goals and meet them. 2, make more efficient use of balance sheets by increasing the risk mitigation tools that we've all discussed. 3, help developing a better pipeline of bankable projects. So once the capital is there, the projects are there, ready to absorb it. 4, expand the country platforms and coordination mechanisms. There's various kinds of country risk and foreign exchange risk I'll touch on a bit later. 5, really use guarantees and harmonize the terms and modalities. The more standardized the guarantees can be from the MDBs, the easier it is for us to use it across a range of different investors and investments. And another one, last but certainly not least, is the MDBs have a tremendous amount of data. And data is such a huge tool for us in the emerging economies market. So, for example, the GEMS database. So one of the key recommendations is really urging the MDBs, like, let us all use that data so that we can deploy investments better and more rapidly.
Thank you very much, Yana. And those are in fact impactful recommendations brought out by the GISD Alliance, and CDPQ and Citi in particular had a leading role there, which brings me straight to a representative from the MDBs. What's your view on those recommendations, and what do you think about the assertion that the MDB's business model is not sufficiently aligned to maximizing total investment?
I think generally speaking, the recommendations come from robust data that that our partners have looked at that actually points to the points that confirms the points that you've brought up. But I think what I wanted to focus the discussion on today is to highlight where I think MDBs have started to move, right? We are not certainly nowhere close to doing enough, but I think there's certain movement that is going in the right direction. I'll start with this idea that MDBs need to help in terms of developing a pipeline of bankable transactions. So at IFC, some of you might be familiar with this. A couple of years ago, IFC introduced a business line called Upstream, which is really about developing a pipeline of investable deals. I mean, part of those investable deals will be IFC investing, but a big part of it will be blended finance, will be private capital mobilization, and it's all about creating markets in which it's easier for the private sector to come in and invest. This is a good model that I think other MDBs could also emulate. Earlier this year, the World Bank as a group adopted what they're calling the Evolution Roadmap. It's again a response to the call to do something different. And as part of this roadmap, we've adopted this private capital enabled as one of the core objectives of the bank. We are in the process of developing metrics and incentive structures within the organization that will help us to make this as important as, booking deals on our own books as a metric of measuring success. I think another point that I will highlight here is the idea that there's a lot of resources within MDBs that have historically been lent directly either as concessional public sector loans or given as grant that could better be used to leverage private sector capital. And there, again, some change that we've seen at the World Bank is the introduction of what is called the IDA PSW window. This is taking money from the pool that is traditionally concessional money, private sector driven, to use that money to leverage more private sector capital. And it's specifically targeting low-income and fragile and conflict-affected countries. And now it's the biggest sort of blended finance pool that IFC has. So I think looking at all of these, it's yes, agreeing with the observations and saying that the MDBs are listening. And I think within the World Bank, we've seen sort of movement that has started to illustrate that it can be done. Maybe the final point I'll make is around this whole point around transparency, where I'll say also at IFC, leading the way for MDBs, we've started to disclose the level of concessionality that we give to our beneficiaries. This is still not a widespread exercise, but again, I think a model that if it was adopted at scale would help us to avoid subsidizing the same transactions, especially in cases where multiple blended finance pools are being used to support the same deal or the same region or the same sector. I'll stop there. And,
Thanks. Thanks very much, Emily. So the movement is in the right direction, and with now a new management at the World Bank, it remains to be seen how further it goes. I don't know, Jay, this is something that you feel very strongly about. I mean, could you just have a brief response to the points that Emily made?
Sure, I just agree that there is now movement. There is an awareness. There is a public dialogue around the reform of the MDBs. It was a big issue at the G20 summit in India. Probably the most important thing, though, in all of this is just the point, Emily, you made about the incentive structures. And if you think not about the MDBs, but about their shareholders, right, the sovereigns, they have allowed a governance construct that was mandated to lend for development. So the construct is to measure lending for development. No one has said at the top of the chart of what you as an institution and you, the professionals in that institution, do, that we have to measure what you mobilize, the private capital mobilization. We have to measure not the $1 you lend, but did it catalyze, did it mobilize some multiple of that to actually set a target? So I have told the CEOs of the MDBs and the leadership behind them that we have to set that target, and then you have to mandate that, because the only way that we will crowd in as opposed to crowding out the private sector is to redesign not just incentive structures, but if you get the incentive structures right, and that is the mandate, all of these products and tools that are involved in the blending have to change because they don't work. They're extraordinarily inefficient in terms of really getting this massive pool of private sector investors to play in the developmental world appropriately. The risk mitigating structures aren't working. If they were working, we wouldn't have ridiculously small numbers of private sector participation. So we certainly now have everyone's attention, but everyone here should be pounding the table to say it's not enough yet.
Thanks very much, Jay. Now we move to a complementary issue, which is about, the sectors and projects that are most suitable to be financed through blended finance. One of the concerns has been that it's been going to perhaps not the most optimal projects where additionality is not created. And I wanted to get the panelists' thought on that. Emily, if I could please begin with you.
Okay, thanks. So I think one of the things that DFIs help to do in this space of blended finance is to design these governance structures that help us to be more efficient and more effective when we deploy blended finance. So, one of the tools that we look at very closely at IFC is this idea of additionality on every transaction that IFC invests in, to make sure that we are not crowding out the private sector, but also more importantly, we're bringing to bear the full value of IFC. So if you think about the economic rationale of when blended finance is most meaningful, it's in areas where there are distortions in the context or where there are different kinds of market failure. And when you look at IFC's sort of portfolio for blended finance, it sits in these same areas. It's a very natural distribution that follows where we think the need is the most. So let me just highlight some of those areas. So blended finance a lot of the blended finance in IFC goes into climate. It's about helping to establish the feasibility of energy transition technologies. A big chunk of it has historically gone into renewable energy. But that's a space actually that DFIs are now looking at to see the more mature renewable energies, how we can reform or evolve the nature of the investments that we make in there. I think in terms of the second largest portfolio, it has been in SME financing with a particular focus on women-owned businesses. I think here blended finance has helped to address market failures that come from a lack of collateral and a lack of understanding of the risk that these types of investments face. And a typical project in this space is in the form of, first loss guarantees that IFC gives in partnership with banks and microfinance institutions that they lend to sort of cover potential losses from specific portfolios that we think are not growing at the right pace, such as portfolios of women-owned businesses. I think the third area, which is maybe more of a theme rather than a sector, is this area of fragility in low-income countries. So in this space, I spoke about the IDA PSW envelope that is there, but more broadly speaking, the blended finance has been used to overcome contextual risks. and to make sure that lending goes into areas where it wouldn't have gone otherwise, through de-risking instruments and some instruments that are of a concessional nature in terms of pricing. So I think in this space of fragile and conflict-affected countries, some of our biggest portfolios in there from a sector perspective is the agribusiness portfolio. I think there, our focus is typically to improve the participation of smallholder farmers in agricultural value chains. There are a couple of examples I can give in here, but one that's interesting is this investment that we did with Malishi, a company that sources shea nuts and processes them for export from a large number of smallholder farmers. I think in this particular transaction, the blended finance was structured as a concessionally priced subordinated loan that was, on one end, providing the cushion that we heard about earlier to senior lenders that were participating in this deal, but on another end, also helping to make sure that the cost of financing was manageable for an investor that was trying to do a greenfield processing investment in a fragile and conflict-affected countries. I think ultimately this was an interesting transaction that managed to reach over 100,000 farmers. So I think from a sort of sector and project type perspective, these are some of the big portfolios. From a regional perspective, one of our biggest portfolios is Africa, actually. So looking at the whole landscape, I would say there's, at least within IFC, there's a nice alignment to where we think the need is the most in the structures that we tend to use in those types of deals.
Thanks very much, Emily. And Namdi, you are the organization with a very comprehensive database on this. What are your thoughts, in fact, in terms of where it's flowing and which sectors are most suitable and projects?
Yeah, thank you. A bit hesitant to say suitable. Our data shows and reflects that the leading sectors are energy, financial services, agriculture. There's a bit of natural selection there because if we're talking about bringing in the private sector, those are the instances where the business cases are most clear. They know that they'll get their money back over time, whether at a concessional level or slightly higher than a concessional level or a market rate. But essentially, it all depends on the problem that you're trying to solve. If you're looking at health or education, it might be something as simple as an impact bond. If you're looking at scaling, then quite naturally renewables comes into play because we know that that's where we can start, creating these aggregate vehicles or portfolio approach that would have a lot more financing come into the deal. So it really all depends on the problem that you're trying to solve, but we see it across the board. And I just want to point out that we're trying to make the argument that there are business cases for all the sectors, specifically adaptation, specifically nature-based solutions. There is a manner in which to construct these deals that fit into that risk-return profile. So I'm staying high level. There's case studies that I can get into, whether it's smallholder farmers are turning organic waste into biogas and starting from a market acceleration grant to raising 20 million, or something way larger like Climate Investor One, where it's a multi-tiered fund with different layers of concessionality that's upwards of 1 billion. But the point that I think I want to make more broadly is there is a business case that is viable in each of these sectors, and despite the fact that there is some selection at the top, that also flows mostly into middle-income countries. So if we're thinking about low-income countries, we still have to be aware and understand that there are opportunities and there are ways to increase pipeline. And it will require a different mix of blended finance instruments and approaches. But in terms of suitable, blended finance is designed to really attend to all of these issues. But you start with what am I trying to solve? Where am I trying to solve it? And then how do I apply the appropriate blended finance structuring? But broadly, absolutely energy, financial services, and agriculture.
Great. Thank you so much. We're running out of time, but we have time for one final question. And here I'd like to go through all the panelists and ask them that. In your view, what are the main opportunities and what are the suggested ways forward for blended finance, really for it to advance and in fact play an important role in filling the sustainable development funding gap? And can I begin with Jana, please?
Okay, well, in the spirit of a lightning round, I'll just say partnerships. I think we need more new and innovative partnerships, and we need to be trying more ways of blending our capital together on projects.
Great, thank you. And Jay?
It's hard to pick one. I mean, part of the problem is there's so many challenges across the board that aren't working, that they all have to work in order for this to happen. But I guess I would throw out there projects. I mean, we don't have, the developmental community and climate community doesn't have enough projects now. And by projects, I don't mean bankable or blendable projects. I mean, how about just start with a feasibility study completed project? We're not funding enough feasibility studies around concepts of government that have a high additionality or a high impact on climate to be able to show the financial community projects that could work, that we could structure a blend around. And I'm kind of exhausted, and most of the banks on the street are exhausted by concept papers from organizations where it's 2 pages and say, could I blend this? Could I structure this? What could I do with this? And a project finance banker wants to see the numbers, wants to be able to build the numbers on an operating model of its financeability. And I mean, when we talk about moving from billions to trillions, it's not possible because we don't have anywhere near that. Let's just say you could do everything that we ask for in the financial space to blend, and God bless Convergence for this, because if we didn't have the data to kind of see what's really happening, we wouldn't really know that everyone deserves a big fail since Addis Ababa in terms of blending. But it starts with project creation. So we're not doing that.
So great. So Yana had mentioned partnerships, and you're mentioning investable projects. Emily, what are your thoughts?
I think some thoughts that are similar to previous speakers. On the one end, we need to do better in using the resources that are already on the table. So I'd say optimization. And it goes to some of the points that I highlighted earlier, which is, things like making sure the financing is going to the right projects, optimizing the leverage ratios of the resources that are already at the table, and there are different ways that we can innovate around that. The second point I would make is really this point around scale. And I mean, we can talk about scale for a very long time, but really figuring out the point around investable projects, really coming in with the right incentive structures to focus on private sector mobilization, the use of existing instruments such as the example that I gave earlier to direct that to leverage well is going to be very important. And there's a role for DFIs there, but there's a role also for different other stakeholders, including the donors into this space. So I think I'll leave it there. Thank you.
Great, thank you very much. These are all complementary points: partnerships, investable projects, optimization of resources to achieve scale. And now finally to you, Namdi, you have the difficult task now of adding on to these points.
Yeah, all very critical points. Where I'll land, I suppose, Convergence was born from a data perspective and understanding data and intelligence around blended finance. So that's where I'll end here, is the need for more disclosure and more data. To put it quite simply, we're trying to replicate projects. We're trying to manage the system of concessional capital and blended finance, but you can't manage what you don't measure. You can't measure what is not disclosed, and you can't disclose and standardize unless those processes are in place. So data is really critical. And just overarching, because all of these points are massively important, ultimately for blended finance, what we're trying to do is minimize the amount of concessionality that's required while maximizing the amount of leverage that those concessional dollars have to optimize value for money. It's going to take a lot of different steps and stages, but considering all the points that we've brought here today, I think it's something that we're moving in the right direction to.
Thank you so much, Namdi. Now we move to the stage where we'll have question and answers from the audience at this late. Please, and if you could please introduce yourself.
Hi, thank you very much for your presentation. Let's look at the landscape or game board of sub-Saharan Africa. And my understanding is that the elephant stamping through there is China, which makes you also think about, okay, U.S. politics, what are they thinking of China's role in putting money into sub-Saharan Africa? How do you apply everything you said today with them in mind? I mean, do you look at what other nations are doing, and are there opportunities and, perceived risks in stepping in, where those other projects are taking place? I just don't know, like, how you view some of the other big players in that field.
I think Jay would like to.
Sure, I'm happy to take a crack at that. So I think first, the Belt Road Initiative has pushed so deeply into Africa that there are all kinds of consequences of that. First is there is a national security consequence that is now in the room of the financial world that wasn't there before, whether that's the greening of the Belt Road Initiative, whether that's the influence exercised in Africa by China, but it's now at the table in the middle of things that we used to think as purely financial. Second is, blending is difficult, or was difficult prior to the massive move by the Fed to raise interest rates. And in the course of all of this, I have a list of 44, 45 countries in the emerging markets that can't fund themselves anymore in the capital markets. So they're either defaulted, or they're borderline default, or they just have no access because the market price to fund themselves is beyond that. So, and that's most of Africa. So in that environment, we now have this thing called the Common Framework, where the official community, the official creditors of Africa and the developing world has invited China into the room of Paris Club Plus, right? And the political discussions around how one restructures debt such that a country that is on its knees and has been for 12 months, 18 months, 24 months, and can't come out of that, can't have any capital formulation, forget blending. Like, nothing works until you solve their debt problem, which are massive, and in all of the, let's call it the double B minus down, it's stuck. You're now stuck in a Paris Club Plus, meaning, let's call it mainly G7 plus China, in the room that don't agree. So those countries are stuck negotiating with IMF, may have a program, may have a staff, what we call a staff level agreement, but because the US, G7, China don't agree on how to move forward with this, no one can move forward. So when people say, okay, blend in Zambia, I'm like, okay, we love to help when the Common Framework is solved. So there are a plethora of issues, just an entire prism that anyone in the developmental space now that would not have looked at the China issues, transparency, security, supply chains, how their debt is priced, and the overall debt markets add a prism of complexity that's extraordinary and make our jobs much more difficult. I hope that helps.
Thanks very much. Can we take a couple more questions?
Sorry, we're out of time. Apologies. Apologies, we are out of time.
Oh, we're out of time, okay.
Yeah, sorry. So the cookie crumbled.
Sorry about that, but you'll have the chance to interact with the panelists after the session. I'd like to thank all the panelists for their insightful views, and to all of you, and importantly also to the CFA Society for hosting this panel. Thank you.
May I also ask the next panel to join me up here in the front of the room. Let's see. Boy, this is hard to see. Where are you all? Tom, Jorge, Maria, Marie, come on down. Go ahead, Mike.
Great. Okay. Hello, everyone. It's a pleasure to be here today. My name is Dr. Mike Rowe, and I'm with Responsible Alpha, and we're happy to be one of the supporting sponsors today. Responsible Alpha is a leading ESG consulting company, announced by the Principles of Responsible Investing, PRI, as one of the 20 leading ESG consulting companies. Despite being a startup, we have already created a lot of impact. We sit on many advisory boards. To name a few, we sit in the S&P Global Sustainable Finance Scientific Council. We also advise the Nature Crime Alliance. And we have recently announced our board of directors, and we're happy. It's a board of 6, and we're happy to have Willis Towers Watson on board. I'm now very happy to introduce the next panel session. It's we will explore the question of can sovereign bonds channel investments towards sustainable development, and it will be moderated by Tom Below. Thank you.
Good morning, colleagues. My name is Tom Below. I work for the United Nations Development Programme as Chief of Programme in our Sustainable Finance Hub. I'm very excited to be here this morning with you. We've got a riveting panel ahead of us. We've got a couple of speakers who are coming in a bit later, so it's going to be very dynamic. We know you've had an intense morning already, and we're a little bit behind schedule, so I'm going to really try and rattle us through this session. As you know, the session is about sovereign SDG bonds as an instrument for catalyzing finance towards developing countries and aligning investments with sustainable development. It's a long title, but it's effectively about debt instruments that have a sustainable development impact. And that's why, as a development institution, UNDP, I'm really pleased to be here alongside our panelists, both investors, development cooperation agencies, international finance institutions. So we've got a real mix of stakeholders here for you, trying to bring different perspectives on what we think is an extremely valuable tool for developing countries. And we think that not just because of the transactions, not just because of the finance immediately mobilized through debt instruments, and UNDP has been involved in the last few years with about $14 billion of issuance. But it's not just that sum of money that's important. It's the systemic nature of the reforms that go around SDG bonds. SDG bonds are thematic bonds, so we're looking at the use of proceeds through these debt instruments. That requires governments to have in place systems that can account for the use of proceeds. Public financial management systems, accounting systems, and impact management and measurement systems to assure credibility of the use of proceeds. There are also governments who have issued what are called sustainability-linked bonds. Now, this is not about the use of proceeds. It's about progress on key performance indicators linked to development policy. The case of Uruguay, most recently issuing a sustainability-linked bond, which had key performance indicators around their nationally determined contributions, their climate policy. So these bonds get to the core of governance and systems in developing countries, and they also provide attractive investments for the investment community, and that's what we're going to be hearing about a bit later as well. So I'm not going to stand between you and this incredible panel. I'm not going to introduce each of you, I'm sorry, with all of your incredible bios. I mean, they are incredible. I am just going to mention your names and your organizations, if you don't mind. And Marie Otterson, we're so lucky to have you here, Deputy Director General of the Swedish International Development Cooperation Agency of the Government of Sweden. You know, really the top leadership of CEDA with us today from a development cooperation perspective. So we'll be hearing more from Marie later. And Pilar, of course, from the OECD, just spell it out for me again, Pilar. It's the Organization for Economic Cooperation and Development. So that's the OECD, and Pilar heads up the Development Cooperation Division there, formerly a minister in Costa Rica. So very lucky to have you, Pilar. And then, of course, we have Tom, my namesake, Tom Taylor, Head of Climate Finance with Viva, and Jorge Ordonez, Director of Global ESG Sovereign Solutions with Citi. So quite the panel, and a World Bank colleague will join us shortly. I'm going to stand up just to keep myself sort of, get the energy going and the acceleration going. It is the SDG Acceleration Week, so that's why we're accelerating here. But Marie, Pilar, I wanted to start with you, if that was okay. Thanks, Pilar. I wanted to know what you think the potential for sovereign SDG bonds going forward is. What could a future market look like, Pilar?
They told me. Now it is. I heard all the instructions. Keep it at a certain distance. Yeah. So, good morning, and thank you for the invitation to be here with you. So yes, we believe that SDG bonds, they provide this very important new avenue in order to access the large pools of untapped private capital in order to align better with returns for strong, sustainable development outcomes. So that is one of the most important for all. For sovereigns, SDG bonds can truly transform public budgeting. They can actually facilitate alignment of public sector financing for SDGs, and at the OECD, we are focusing on some of two types of bonds in particularly. So the GSS bonds, Green, Social and Sustainability bonds, which are use of proceeds instrument which finance specific assets, for example, green student housing or and sustainability-linked bonds, which are a bit different and are a bit more fungible, and they are tied to achievements that of predetermined sustainability objectives. For example, some of the sovereigns, they lend to themselves, particularly on the incentivizing progress towards reaching the Paris Agreement, or, for example, having more ambitious nationally determined contributions. So what we say is that these are not in competition. So GSS bonds and SLBs are highly complementary. So it shouldn't be a matter of choosing between both of them, but it is a matter of using them strategically in order to leverage and accompany countries under their leadership at a country's development, sustainable development pathway, and to be best fit to sustainable financing needs. Within my directorate, the Development Cooperation Directorate of OECD, we are working towards increasing volumes, which is what we have heard a lot in UNGA, so how to raise more volumes, but at the same time, we're thinking about the quality of those flows. So how are they more effectively being channeled towards developing countries? Scaling up the issuance of these bonds in development countries is a very important part of that. And despite the huge potential of GSS bonds and SLBs, developing countries are accounted only for 6% of the total issuance in 2022. So when we think about what a future market will look like, to get down to business, we need to remember that, that the SDG bonds are not appropriate for all contexts. Debt sustainability and the overall risk setting of the country needs to be carefully examined. And so other instruments have been put into place in order to better accompany the country, whether it is to improve their macroeconomic situation, to de-risk, or to find the right way in which they can actually operate. SDG bonds bonds must be therefore seen as one of the many, many tools in the development finance ecosystem, but one that can and must bridge what the SDG financing gap of 4 trillion per year is now knocking at our doors. Thank you.
Pilar, thank you so much. That was incredibly insightful. And of course, as you remind us, the macro fiscal fundamentals need to be in place for any kind of consideration of a debt instrument, including SDG bonds. So I'm now going to move, if it's okay, to you, Marie. And again, great to have you here as a development cooperation agency. I think a few years ago, we wouldn't find many development cooperation agencies on a panel talking through SDG debt instruments. So this is a sign of change in itself. And I know Sweden has been a strong supporter of the agenda. So Marie, over to you with the question, what do you think some of the obstacles are for scaling up the SDG bond market for countries?
Thank you very much, Tom. And I must admit that this is a difficult question for me to answer because I see myself as an optimist. I see myself as someone who always looks for the opportunities. But I think that, Pilar, you explained so well why all of this is so important. So I think that I can maybe have some comments then regarding the obstacles, because that was your question. But I would still like to say that before I answer your question, I would like to say that I think it is very important that whenever we address obstacles and challenges, I think it is important to remember that they could be turned into opportunities and challenges as well. And I see that we as development partners have a very important role to play there, but it's not a role that we can play in isolation. We need to work together with all of you in order to make that shift. But then moving on to some of the challenges, I think that you touched upon this as well, Pilar, but I think that it's important to remember that all countries, they are different. And I mean, if we look at in the countries in which we are working, they all face major difficulties already. They are affected by climate change already. I think that all of them are also having big problems when it comes to maybe already being in a conflict or after a conflict, or they might also be affected. No, I don't remember if I didn't say corruption, that was the third thing. I think that all of them are also heavily affected by corruption. And that, of course, also means that we as development partners need to address all of these challenges differently. But in addition to that, I would also like to say that I have written down some of the comments I want to say. No, but I think it is important also to remember that not all countries are fit for issuing new debt instruments. It could be because they already have a high debt situation today, so it's possible to go higher than that. And they need to put their time and resources to strengthen their domestic financial system. So this is not what they can focus on right now. But to keep in mind, I think it's important to say that most of the low and middle income countries, they need also to have finance their long-term sustainable development in order to achieve their SDG targets and their different climate goals and so on. And that has to be done nationally. So I do think that we all have an important role to play, and I will not have the time to elaborate on what we can do as development partners, just to say that I do believe that INFS and so on is one important way to make sure that we can overcome some of the challenges. But I will stop there.
Great, thank you so much, Marie. And thank you also for highlighting at the end there the INFFs, Integrated National Financing Frameworks. And I think actually, Marie, just reflecting on this week, we've seen a lot of discussion in the UN around how the financial architecture, needs to reform. We all know that, but we're hearing from many of our developing country partners that they're not waiting, that they're putting in place reforms, financing frameworks, like Marie has just mentioned, to really try and mobilize all sources of finance for sustainable development. But I'm now going to come to our investor friends, and in particular now to turn to Jorge from Citi. And, it would be great to hear from you how you think investors can play a role in incentivizing our developing country partners to align with the sustainable development agenda. Of course, there are many challenges in the financial architecture around access to affordable credit, etc. But what is it that the investment community can do, perhaps, to incentivize our developing country partners? Over to you.
Yeah, thank you. So, look, Citi has been in this space since the very beginning. We co-authored the Green Bond Principles back in the time. So, we are happy to see that the market has evolved to the point where it is now. When we work with governments, which is the clients that I cover, we basically try to work with them to establish the necessary capacities to mobilize investments into SDGs. And that means trying to, many of the emerging market countries don't have the institutional capacity to execute these type of transactions. And we partner with technical experts such as UNDP, World Bank, and others to work with the governments to develop that expertise and knowledge. So we've worked with several countries on training sessions where we talk about everything from the market and starting with what's a sustainable bond and going all the way through bond execution. How do you put together a framework? What's the type of information that needs to be shared? How should the ministries interact? Second-party opinions. What's the investor universe look like? And that's kind of like our expertise, more from the market point of view. Then we let the UNDP and the experts deep dive on really, what's the criteria for selecting projects and impact reporting and data collection, which requires a more technical expertise than a bank can offer. And I think when we address these knowledge gaps, it's much easier for issuers to grasp what needs to be done to issue a green, social, sustainable bond. And then ultimately, we work with them on the bond execution. So we help them put together the frameworks, if that's the case, or to issue and place the bonds in the market. And an example of that is the government of Benin in 2021. We worked with them. We helped them with the with their SDG framework, which touched on 12 eligibility criteria across all SDGs, aligned with ICMA, Green Bond Principles, Social Bond Principles, and then we subsequently helped them place their 500 million euro bond in 2021. So I think from our perspective, it requires a lot of capacity building. And then for recurring issuers, you have the examples of Chile, which it's like the largest sustainable bond issuer in the market, that they're extremely advanced, and there's also need to share those experiences amongst countries and some of these, there's initiatives like the Coalition of Finance Ministers for Climate Action, where finance ministers actually get together to talk about aligning climate with budgeting and fiscal planning. And that experience, that sharing of experience is very important to make these, to scale this market and continue to see it grow.
Thank you so much, Jorge. That was great. And I think, just listening to you talk, you can hear how development and finance are coming together behind these instruments. And, for somebody who's worked in development for a long time, I really feel like we're building momentum in a way that has not been there before. The fusion of finance institution expertise and development institution expertise coming behind these sovereign debt instruments. And look, I know there's a lot more to do to scale up the SDG bond market, and I think it would be great, Tom, to also hear from Aviva, what you think is needed, what new partnerships, what does the development community and investors need to do together to scale up the market. Is that okay, Tom, to pass to you with that?
Yeah, of course. Thank you, Tom. Thank you, everyone. It's great to be here. So I think that scaling up is really important. So from an institutional investor point of view, the sovereign debt market is critical. So Aviva as an insurer under the Solvency II regime has huge incentive to invest in sovereign debt. So it's one of the biggest elements of our portfolio. And with the commitment of institutional investors to things like net zero, the support for the SDGs, the demand for instruments that align with these frameworks is only going to increase. So there's an incentive on us because we want to show that within our portfolios. There's also a responsibility on institutional investors working with the development community, working with civil society, but also working across the investment community to engage with sovereign issuers of the instruments whom we hold. So, being at the CFA Society, so it's bread and butter. Stewardship of corporate assets is very familiar, but stewardship of sovereign assets is less familiar. And the role of institutional investors holding huge amounts of this debt is very important, and there's too little engagement at a sovereign level. And I think that's important because ultimately the trillions that Pilar mentions aren't going to happen instrument by instrument. We actually need to evolve so that the whole market aligns with achievement of the 2030 agenda writ large. And knowing that is also the direction of travel that institutional investors want to see is important. So engaging with issuers, so for example, at Aviva, we this year have written to 50 countries, finance ministers and central bank governors on specifically development and climate issues, asking them to align their NDCs with their whole sort of financial ecosystem with their NDCs, with their commitment to things like the Kunming-Montreal framework, with the SDGs, and saying that's what we want to see as investors. So stewardship's important. The use of proceeds is critical on these instruments, but actually the use of proceeds across the whole of the sovereign and sub-sovereign instrument market, which is about a third of the liquid market, is also critical. Because if we've got these specific instruments in small pockets, but actually we've got huge amounts of sort of vanilla debt that actually is continuing to fund the wrong things, then we're not going to get anywhere. And it's a little bit like a quote I saw yesterday in the context of this very welcome ambition to triple up the deployment of renewables, saying it's like training for a marathon while smoking 5 packs of cigarettes a day. And it's like that. So we need to grow the whole ecosystem. And so the last thing, I think, again, all working together, so sort of every organ of society, to borrow from sort of the human rights ecosystem, working in lockstep on these issues that are in everybody's interests. And so, you mentioned, Tom, the growing clamour for reform, renewal of the financial architecture, but needing that to be holistic, not just saying this is an MDB problem, this is a regulatory problem. So needing to look all the way across MDBs, IFIs, but also the regulation and supervision of private finance, where, as we heard on the last panel, Jay was talking about the fact that that architecture at the moment is designed to avoid another 2008, not to deal with the problem that we know we need to deal with this decade ex ante, and we can't deal with ex post, which is the development and climate crises. So thinking about how we embed that in the purpose of the architecture is also important, and that's where expertise from the development community and insight from the finance community can come together.
Great, thanks, Tom. Music to my ears, and I'm sure to others too. I mean, really, this is the tip of the iceberg, the proverbial iceberg. And, I've been hearing again over the last few days in the events at the UN that on the one hand, we're seeing how fossil fuel subsidies have already now reached $7 trillion of public investment. And yet somehow, we see the hope behind sovereign debt instruments aligned with climate action and sustainable development. It's not quite tallying, I think, is the message you're giving us, Tom, and really that we need to put this at the heart of financial decision-making, not just niche instruments, but the whole of the financial market. Now, there are ways in which this can be done which are disingenuous. There are ways in which we see the SDG market being but a facade, window dressing. We hear a lot about greenwashing and SDG washing. You know, we're all very good at talking about it, but are we really having an impact on sustainable development in the ways that we want? And I just wanted to pass perhaps back to our development institution friends in CEDA and OECD, just to check in with you on, you know, what you think some of the risks around this SDG washing might be, and how we might be able to address those risks and ensure the market grows authentically. So maybe Marie, over to you on that one.
Thank you very much, Tom. And this is, of course, a very important question. And I think that we have an agreement sometimes when it comes to, I think I know what I'm going to say anyway, but thank you. No, but I wanted to say that when it comes to both investors and development actors, I think that we do understand that we need to advocate, and we all see that there is a need for transparency and reporting around the SDG sovereign and green sovereign bonds. And one can also include all sustainable bonds for that matter. So we all need that there is a need for transparency and reporting around that. So that is not really an issue. Then the issue is how do we make sure that this is really going to happen? And I think that by reporting the certain key performance indicator could, of course, be one way of doing that. I think that another way could be also to have a third-party verification. And what we have discussed also internally at CEDA is that we could have more focusing on auditing, because that is one way of ensuring that we're doing it in a good, transparent way. And I also know that the GISD working group on SDG sovereign bonds, they're also working on different recommendations when it comes to transparency. So I think that it is fair enough to say that we are doing a lot of things. Yesterday, I also attended another meeting where GRI launched their Carrots and Sticks report, which is the world's largest database for ESG and sustainable policy. And I think that what I also said in that session is that we need to work together to find how the interest of development and meeting the SDGs can coincide also with business interests and provide incentives for companies to do out of self-interesting that they want to do more and to do better. And I think that this Carrot and Sticks database and reports are important tools showing how the non-financial and sustainability reporting, as well as the role of transparency, can promote incentives for corporate change. And then I would also like to add one more thing. And I think that nowadays we talk a lot about volumes and quantities. And Pilar and I was also discussed that in another panel last week. But I would also like to say that it's also important that we address this to make sure that we do this with high quality. And there are different means of doing that. I'm thinking that Sweden is also co-chairing the Global Partnership for Effective Development Cooperation, where the Kampala principles play an important role. They can also be in line with the work that is done with INFS. And that is also an opportunity to make sure that we have good interactive dialogues at the country level where the action is taking place. I see many opportunities in order to make sure that we can work on the risk in order to make sure that we will have sustainable results in the long run. So I will stop there, Pilar.
The first thing is actually it is loud and legitimate. Well, we're listening about greenwashing. It is, however, something that we have been seeing, and it is affecting negatively, like the use of the SDG and the development of the SDG bond market, but overall trust that people have on these instruments, and they're becoming a bit unattractive for private sector. So what we believe is that the importance on how to counter this greenwashing and how to increase the integrity of the SLBs and the GSS bond market, and it should be, and it is at the core of what we're doing with all donors and at the donor efforts. And here I see Maddie. So let me focus on just one element here, which is the development harmonized principles and at the same time standards for both GSS and SLBs. So it is very important to create this common language so that we understand and to define expectations so that it makes it easier for investors in order to compare. So what to expect and what would be like the right bond and how to allocate resources and at the same time how to help issuers issue their bonds better. And when it comes to GSS funds, it is very important to understand the taxonomies and to understand also what is green and sustainable. And for SLBs, it is also very important to coordinate KPIs in order to use and demonstrate and measure impact, and in order to assess the material degree to which these ambitions will actually be happening. And for both, there is this need to harmonize measurement and impact on reporting practices. So in developing countries, these are best practices. They challenge how we do and how to define also the right balance between harmonization and adaptation. So yes, we're working on harmonization, but it is also about how it's best accommodating in different country contexts. And the last thing would be strong coordination between and among donors, so that we also see not only donors but other actors thinking about what you also said within the development finance ecosystem, so that we can actually make it all coherent in terms of our policy work and in terms of what we expect for it to better impact the overall financial ecosystem and to move forward in terms of this acceleration we aim for.
Great. Thanks, Pilar. And talking of acceleration, just like to welcome Svetlana, who has accelerated herself to the panel just now. Svetlana Klimenko is the global lead for sustainable finance in the World Bank. If you're ready, I'm going to pass a question straight over to you, Svetlana. I know you're always ready. We've had a range of perspectives on the SDG bond market and potential to scale that up together. I also just wanted to hear from the World Bank perspective, what you think is needed from the development community and from the market to really take SDG bonds to scale. So Svetlana, over to you and welcome.
Thank you. Thank you very much. Yeah, and apologies for being late. I was in the meeting on the other side of the town when all roads got closed. So it is a pleasure to be here. And I have known this question in advance, so I had the chance to prepare. And there are two sort of dimensions that I would like to highlight. So first, when we speak about SDG bonds, usually attention immediately goes to the moment when the bond is issued. Right? So this is where there is all highlight and the press release and everybody is focused on the number and the event happening. And of course, this is very important. And of course, to put together this kind of bond requires certain effort and knowledge of how this structure would work. However, from our perspective, what is much more important and what investment community really should be paying attention to is what kind of effort goes into preparing the issuance of the bond in terms of selecting projects, in terms of assessing government's capacity to implement these projects once the funding is mobilized, and in terms of the capacity and credibility of the proposed measurement mechanisms. So essentially, if you think about this, the worst case scenario would be when we have some very nice, shiny issuance, and then there is no impact. So money goes somewhere in the government system, but we don't see actual impact on the ground. So, and now, as probably many of you know, there is a lot of focus on MDBs, and the World Bank in particular getting more engaged into this agenda of mobilizing private capital through a number of channels, including the SDGs. And I see some friends here with whom we have been working on this for a long time. So now, for a change, I'm being on the cautious side when I'm saying that please don't place your full focus on this final point of having some innovative, very nice instrument which goes into the media and which draws attention. Because for all this to matter, we really need to spend a few years, often it is few years, working with the government, helping them to figure out how to select the right projects first, helping to sort of to put together the strategic framework, right? Because this bond is just the mean to an end. And then sort of putting in place mechanisms which would give you investors, other stakeholders, now we have much more active sort of civil society, as you all have seen in these last few days, the sort of the assurance that what is being raised from the private sector is used for the right purpose. I'll stop here.
Great. Thank you so much, Svetlana. And that's a great way now to segue into opening the floor for some questions or thoughts from the audience. I still have one question I want to get back to Citi and Aviva around, what's really in it for the investors? Let's cut to the quick. What's really in it for investors? But before I turn to them with that question, any thoughts, suggestions, queries, please? I don't know how the system works. Here comes a microphone, accelerating round the corner.
Thank you. I wanted to ask a broad question, but let me just introduce myself first. Anthony Berkeley, Head of Investment with FII Institute. We're a nonprofit foundation and think tank formed in Saudi Arabia by royal decree. And we're most well known for hosting the largest annually recurring investor conference. It's held outside of the US or Europe. Think of it as sort of the Milken Global Forum in Riyadh. It occurs every year at the end of October, so we're gearing up for it now. This year it'll be 24th to 26th, and we get 6,000 global investors descending on Riyadh, all the tier one financial media, and for those 3 days, indeed the global capital markets focus on Riyadh. So it's quite exciting, and I lead our investment program. So that leads me to my question. My personal experience of this market is that when you have a well-structured investment-grade sustainable bond, there's no lack of demand for that sucker, and people buy it and hold it till term. And so the issue is really, around that supply, and then around the creation of product that, fills out that creditworthiness scale, and then demand on the investor side, maybe for the lower end of investment grade or below investment grade. And please correct me if that's an inaccurate perception. But my question would be back for the investor-facing or investors on the table. And as you look at your institution and at your colleagues on the asset owner or manager side, what do you see as the big barriers here to really get a little more aggressive in the market and to do more from the investor side in terms of getting excited about these products, tackling our own perceptions of risk that are not always well-grounded, and just moving the investor community forward in this product class?
Great question. And I am going to pass it to our colleagues from Aviva and Citi in a minute. Any other questions while we've got you? We haven't got a lot of time, so do get it off your chest if you have a query. Yes, please.
Thank you. Nadia Nikova, Allianz Global Investors. My question is around blue bonds. I mean, we have somewhat of a green market and so on, but blue bonds, how do we create a market in an instrument that doesn't quite exist yet? Investors want liquidity. If there isn't liquidity, they want a premium for liquidity. So how are you thinking about market creation in some of this less liquid, more new and innovative products? Thank you.
Okay, we'll take one more.
Arsalan Mahtafar from JP Morgan. On the topic of stewardship, I was wondering what type of data and fact base would be useful for investors from sovereign issuers beyond the type of reporting that is required in the SDG bond framework, but more at the entity level that maybe us sell-side advisors could help those entities produce that will aid you in your stewardship process?
Okay, great. 3 really brilliant questions. I'm going to start with our friends in the middle, Tom and Jorge, to respond to any of those questions or all of them, but succinctly, because then I'd like to pass to the other colleagues on the panel. So, Tom, do you want to go first?
Yeah, thank you. So if I pick up the stewardship question, seeing as I raised stewardship, I suppose. At a sovereign level, we don't yet have an equivalent, for example, of TCFD for sovereign. And there are reasons behind that in terms of concern, certainly within the TCFD itself, about adverse consequences from that disclosure on the credit rating of issuers. But let's not pretend, like the credit rating agencies know that, for example, Bangladesh is flood exposed, it's not as if the fact that there's no TCFD report saying that means that nobody knows the risks exist. So it's more about then thinking, how are you going to, what's your plan for addressing those risks? So this is, I mean, it's the same whether it's in the private sector or in the sovereign sector. Essentially, the questions need to stop being, what's your historic reporting and what is your future plan? And we need to, so the language of sort of transition plans is key here, I think. So thinking about so 10 days ago, we got the synthesis report of the global stocktake. And I know that's climate focused, but actually the issues are increasingly recognized across the whole of the SDG and development sphere. And that talks about the need for whole of government, whole of society responses. And ultimately what we need is whole of government plans for how you're going to fund your sustainable development, how you're going to decarbonize and still grow. And markets need to be able to believe in NDCs and the plans that sit behind them. And at the moment, that there's a huge disconnect there. So whilst, yes, there's stuff that could be done on the sell side, actually it starts with governments. They need to produce plans and disclose plans that explain how they're going to go about decarbonizing their economy, achieving their development goals at the same time as looking after their people. And that needs to be at a level that covers all of their key sectors and dependencies for that transformation, and in the sort of detail that investors can engage with. And as we heard in this panel and in the previous panel, there needs to be a lot of support to do that, particularly for least developed countries. They're going to need technical assistance. We need more than, as Jay was saying, two pieces of paper and hoping that that's enough to get your project funded. And this is difficult, but that would be my response, that as a investor community, we say, we've got money here that we want to invest, and at different levels across the scale, because actually we can't sit saying, it's okay, we're going to hold developed country bonds and we'll be safe, because this is all connected. And we actually protect the value of our developed market investments by investing in emerging markets and developing economies. Because ultimately, if all this isn't achieved, then what we really have is a financial risk, clear and present financial risk to the integrity and stability of the financial system. And that's why, kind of to the question that I'm anticipating from you, is why, as investors, we care. Because we can't, as an insurer, insure a 4-degree world, and we need to make sure that we fix this problem together.
Thanks so much, Tom. I'm just going to pass straight over to Jorge.
Yeah, on blue bonds, it's not an easy question. I think ICMA just came out with guidance on blue bonds. That's a start. You need standardization, guidelines that tell you what it is that goes under a blue bond, right? And the other thing is the commitments of 30 by 30 that were agreed on in Kunming last year, that also give some benchmark for what should be looked at in terms of use of proceeds or KPIs for a blue loan, for a blue bond. However, I think it's the metrics getting to the place where you can develop metrics that are comparable. It's going to take time, which is similar to kind of like the social bonds as well, and which is why you have a dominance of green bonds in the space, because it's much better understood what the metrics are. So I think to some extent the debt for nature swaps that have focused on marine conservation are shedding light on that area and marine spatial plans and kind of like the things that the experts look at when talking about marine conservation. But I think it's a matter of starting with kind of like the smaller transactions, proof of concepts kind of thing, and as the market gets more standardization on metrics and guidance, I think hopefully we get to more scale. And then on the question on investment grade versus sub-investment grade, it's clear that investment grade countries have a better chance of getting these deals done, but it goes back to preparation. I think those are countries that have the institutional capacity to put the infrastructure in place to tell a good story, to go to an investor and say, this is what I want to do, and this is how I want to achieve it, and how I'm going to report it and you know, show impact. A lot of the institutional capacity is lacking, of course, in sub-investment grade countries, and that's why we need to support them more in terms of, you know, the work between development banks and organizations with the countries and the financial sector to kind of like get them there, right? But at the same time, I think instruments like guarantees come in as well, you know, so if you're doing a KPI sustainability-linked bond, you probably need an outcome payer that, you know, takes the hit if the KPI is not achieved. We have to think about innovative ways on how to. It's not easy for a country, for example, in a KPI bond, to politically argue that, you know, I'm going to pay more because I wasn't able to achieve something that I committed to, right? So we need to find a way to support those countries, and you know, if there's an outcome payer that is willing to support that, that necessarily, you know, you could recycle the penalty, let's say, into other guarantees for others, right? To keep doing KPIs. So I think you know, it's a matter of institutional capacity one, and then mobilization of private sector to through de-risking alternatives.
Great, thanks. We'll pass to you, Svetlana, and then we'll come back this end and then have to bring things to a close. Svetlana.
Thank you. I actually wanted to sort of pick up on another dimension of the question that Nadia asked about how to invest in the areas which we are less familiar with. So, as you know, next year, Brazil is going to have their G20 presidency. It is going to be heavily focused on the nature-based solutions to climate change. Yesterday, we were at the event at the Harvard Club, which was convened by the TNC and which had Secretary Kerry and Minister Haddad, Minister of Finance of Brazil, and big part of the conversation was that these two countries and other countries are going to collaborate very closely on the nature-based solution, Amazon, of course, oceans also, and there would be very significant investment requirements, big part of which is going to come from the private sector. So what does it tell me, sort of just by listening to all this, is that there would be need to define exactly what you are pointing on. So if you are trying to invest, to bring private capital into nature-based solutions, first of all, you need to define what are these nature-based solutions. Because up until now, we have this little, sort of relatively little bonds here and there, but they're very different, they're very bespoke, there is no standard, and the knowledge is not shared. So I think that in the next year, we are going to see a lot of attention paid to this, and this is going to be very important. And from our interactions with the government of Brazil, we know that one of the first things that they want to focus on and work through is what are these supply and value chains that they are trying to decarbonize that are linked to nature, which normally should help you and people from the financial sector to then sort of structure the interest. So what we will try to do as we work with these different parties is to bring together the voices of the private sector and the government, and they already said that they're going to be much more engaged with the private sector to work in parallel on these two dimensions, what and how.
Great, thank you so much, Svetlana, for that thought to the future. Pilar, over to you, and then Marie.
Just perhaps, like the blue bonds have been, was it $5 billion from the markets, and it's just it's little. It hasn't been a major issue. I come from a country that is 10 times bigger in the ocean than inland, so I really see the value of conservation and of nature-based solutions, both for adaptation and for mitigation, in terms of addressing all of this, but you really need to have like a clear idea of, are you going to commit yourself with sustainable tourism, with the conservation of blue biotechnology or for the future, are you, or the marine biology that you have, or are you going to do it on the ocean's floor? So you really need to know what is the bond going to be dedicated to, and then there's this whole other issue about the appetite and all within a broader framework of sustainability and with the right macroeconomics and where blue bonds are actually a viable instrument financially in that specific country. We've heard some of this, and some of these are solutions for highly indebted countries like SEEDS, for example. And so perhaps in those we need some intermediate financial instruments like grants for protection of marine ecosystems or marine service payments, or in order while we address other issues of their debt, and then we can think about later on a solution for that debt and how those blue bonds can be restructured or part of the equation in a way that they contribute. Just we have to be mindful, and something we have discussed yesterday, of the ratings, because some of the instruments affect, some of the nature debt swaps affect how the market is reading that, and it is not a positive sign. It is saying we can no longer pay for our debt, so we're recurring to this, and so interest rates just fly up, or you become more risky, or some of them have interpreted this as also selective default in some cases. So we have to be very mindful that we are actually creating fiscal space and not sending the market a negative sign. So that would be my contribution.
Thank you, Pilar, for that contribution. And Marie.
Yes, thank you very much, Tom. And I think that I would like to start by sharing an example. I think it's 7 or 8 years ago since SIDA started the network and platform with the biggest investors in Sweden, and the purpose was for them to make more investments and helping us to reach the Agenda 20 and the 17 SDGs. And then a few years later, that was also replicated to the global level here within the UN when they're talking to the global investors for sustainable development. And the reason why I am mentioning these platform and networks is because I think that it has served its purpose very well, because not only do they have a lot of money, it's also an arena where you can share knowledge and expertise and where you can address the challenges that you have raised here today. So I will not try to be any more specific than this, but I think it is important to see what we can do jointly together and create different arenas to make sure that we actually do things differently and not continue doing the same thing. And I think you phrased it very well before, Tom, because you said the momentum is now, and I think that is very true. So that will be my response, even though I did not respond in detail to your questions. Thank you.
Thank you so much, Marie, and thanks so much to our panelists. I think, just a few takeaways that I'd like to highlight. I mean, one, I think SDG debt instruments should not be seen as a flashy instrument. Don't get blinded by the cameras and the press releases around these instruments. In fact, the benefits or the potential is less the short-term transaction, but perhaps more the long-term systemic change they may be part of. I think that, for me, is one of the takeaways. It requires a lot of work from a sovereign around governance, policy, financing policy, not just development policy. The project selection, the key performance indicators, the reporting around use of proceeds. These are fundamental requirements that go to the very systems of government. So don't focus on flashy short-termism here. Look at the long-term potential. And I think, a very pervasive message from the panel is that they also are instruments that require stakeholders to work together in new ways. Investors, international finance institutions, development institutions, and governments and stakeholders at the country level. I think we're all aware we're only at the tip of the iceberg when we talk about SDG bonds, and what we really need to focus on is the market as a whole and shifting the focus of risk and return away from short-term profit to longer-term sustainable development, return and profit. But it's been a fantastic panel. I know that GISD, UNDP, and partners are developing some guidance around SDG bonds, and it would be great to get more perspectives from you all, as well as, of course, the panelists who were already seeking support from in developing this guidance as a way of helping governments and investors and others collaborate further in this regard. So thanks so much for a great panel. Enjoy the rest of your morning, and a big round of applause for our panelists.
I'm going to go ahead and get started introducing our next panel. So I just was thinking about some of the words we've heard today. We've talked about partnerships, investable projects, and optimization to move us along. Well, this panel, I believe, has it all. We've got, do you want me to?
Oh, everyone please be seated. We're going to be starting right now.
Okay, so I'm going to reboot here. So, as I was mentioning, we've heard a lot today about having partnerships, having investable projects, and optimization of everything everyone's working along to really move us along. This would involve the UN, governments, private companies. Well, our next panel has it all. We've got institutional investors, we've got a global investment bank, and we've got all the players, really, to create these partnerships. So with that, I'm going to turn it over to Dr. Hubert Danso, who's the CEO and chairman of Africa Investor Group, and also the chair of the CFA Asset Owners Council. Hubert?
Okay, great. Thank you very much. Great. Well, good morning, everybody. Glad to see you're still in the room, and hopefully you can join us as we go through something which we think is slightly different from the average discussion as it relates to crowding in private capital and mobilizing private capital. I think we're going to place a lot of emphasis on the word scale. So I think I've already been able to illustrate scale, but just by the number of people that we have on our panel. But although I don't think that's the job done yet, because I think you're going to be more impressed with what they have to say than the constellation of them all set out there. So first of all, a very warm welcome to you to this particular panel on closing the emerging markets and developing countries investment gap. We're calling it a lab session as distinct from a sort of a normal panel discussion, because you know, I sort of view each and every one of my esteemed colleagues here as scientists. They've been passionately experimenting, exploring solutions for the, problem of addressing this market failure of mobilizing private capital at scale for developing countries for a very long time, decades in some cases. So this lab arrangement is really designed to have them share the findings of all of their experience and expertise to put forward a number of very key and specific solutions and recommendations that ultimately will be shared with the COP28 presidency. I think we all may have a perspective on that. COP26 got the finance agenda, onto the, COP process. COP27 then doubled down on that, started talking a little bit more about multilateral development banks. And now we know that COP28 is really seeking to put finance front and center. And we think that this is going to be a contribution towards that thinking going forward. So we're going to address a number of different points. It's sort of broken up into two segments. The first one is really going to be looking at the fundamentals and the imperatives around addressing scale. And I think what we want to sort of move away from is this sort of discussion around developing countries and emerging markets and getting to scale. And then we then end up talking about these little micro approaches. And then when you conglomerate them all, we know that it's a very small piece of the overall agenda. So this panel and my esteemed scientists and reporters are going to address that. So we're going to be looking at private capital mobilization at scale strategies, the role of data and securitization, the GEMS, the infamous GEMS database. We're going to be talking very specifically about the bankable project pipeline. That's a $3 trillion nationally determined contribution project pipeline in Africa, or larger. It's a $23 trillion potential bankable pipeline for emerging markets, or larger. We're going to be addressing that. We're also going to be talking about the enabling investment climate and how hospitable the legal and regulatory frameworks and the procurement frameworks are to crowd in the participation of private capital and investment at scale. Then we're going to round off. We have three colleagues that are asset owners and from the asset owner community that are really going to, again, add their voice, talk about some of the really important things that they're doing and some of their perspectives about how to mobilize private capital at scale. So let me just quickly race you through who we have on this panel, and that will probably leave us about 5 minutes to actually have a discussion. But that aside, we have Jared Glansbeek, who is the Executive Director and the Chief Investment Officer at Riskura. Don't feel shy to give a round of applause as I mention their names. I think you're going to find what they have to say very interesting. We have Jay Collins, who is the Vice Chairman of Banking and Capital Markets for Advisory at Citi. We have Mahesh Kochhar, who is the President of Structured Credit International Corporation. We have Guli Sabahi, who is the Senior Advisor on Climate Finance at the Nationally Determined Contributions Partnership, also known as NDC Partnerships. We have Pedro Galzo, who is the Chief Executive of the Investment Management of the UN Joint Staff Pension Fund. We have Eric Krypton, who is the Director for Business Relations at CDPQ Global. We have our Sovereign Wealth Fund Community Representative and CEO, Duncan Bonfield, who is the CEO of the International Forum of Sovereign Wealth Funds. And we are anticipating a colleague to join us shortly, Sonia Medina, who is the Executive Director for Climate at the Children's Investment Fund. So to get us going, just beginning to look at this sort of the investment thesis component and the proof points and the fundamentals, I'm going to call on Jared to come in and just give us his perspectives on asset allocation at scale and just really talk to the performance-related issues. And I think the sort of point that we really are going to hear from Jared on is, something that we all know, that institutional allocations absolutely need to be exponentially increased for Africa's and the emerging markets and developing countries' $3 to $23 trillion investment gap or investment opportunity. So I suppose, it's really good to get your views on how can this be delivered. What is your pitch as an advisor to institutional investors about how this can be done and how this potential asset class can become a reliable and stable piece of asset owners' portfolios? So over to you, Jared.
Okay, thanks, Hubert. I think to start off, when you look at our clients, and there are two unique things about our client base. Like many people here, the clients are very large, and I think what's unique in terms of our client base, who we make these pitches to, is they are invested primarily in developing frontier and emerging markets. So these are people who have actually put money in, and they are institutions. And ultimately, when they're looking at strategies, they have liabilities which they need to meet, and as a consequence, that's really what they're investing for. So what I'd like to do then is just say that the challenges in that area, well, there's been one primary challenge over the last 15 years, and you've all had to deal with it. That's a strong dollar and a weak everything else. And so when all these institutions are contemplating investing, guess what they do? They look over their shoulder, and by the way, it's horrible, and they say, no, I'm not going there. Okay, so let me just talk about why these investors, these particular investors, have actually invested. So the first thing to note is, and I'm just going to use Africa as an example, if I may, because that's always the contentious continent. So if you look at Africa, what's been really interesting on the fixed interest side, and that's or fixed income, and that's a very broad category, actually the performance of that category, and that's quite an important difference between the way I would look at this and maybe some of my colleagues here, is that when you look at the portfolios, the beta has been so good. And if it's been diversified, the alpha, which has been choppy, the alpha being your extraordinary returns, can go either way. But if you have a diversified portfolio and you recognize that, let's say, risk can be priced, sold, avoided, or by the way, pooled. When you're pooling these things, you're getting rid of that risk. And when you look at that portfolio, it's actually done very well. And it's done extremely well. So that part of the African story has actually been very good. And it's easy to look over your shoulder and forwards, given how high yields are now, to actually say this is going to carry on doing well as long as you have a well-diversified portfolio. So I'm not going to worry about that. The second area where people are far more let's say, concerned is equity. And I just want to give you what has been positive for us in recognizing Africa in equity is we have, let's just say, a unlisted private equity portfolio, and so it's unlisted and it's across a variety of countries and companies. To the extent of about 150. So it's actually quite a diversified portfolio. What's interesting is if you look at the vintages going out 10 years, the earnings growth. Now remember, when you're running companies or you're looking at companies, and many people here are CFA charters, the earnings, and Benjamin Graham will tell you this, are really what drives company returns. So if you look at the earnings growth, what's really interesting there is over the last 10 years, the earnings growth on this specific portfolio is the same as the earnings growth on the NASDAQ, 10% odd in dollars. And by the way, and it matches the Russell 3000. You can actually just pull this off a Bloomberg. So you can go and look at the earnings yield, take out price, and just see what the growth is. So what's interesting there is then you would say, okay, well, the performance should be the same. And no, it hasn't. The NASDAQ has had a multiple which has shot through the roof. The Russell 3000 has had a multiple which has been pretty flat over that period. And Africa has gone down. So same kind of earnings stream, but when you look over your shoulder, no one wants to touch it, not because of the quality of the companies, but because of the multiples and the ratings. Now, here's where it gets interesting. Over the last 3 years, I'm just going to skip a whole lot of analysis, but over the last 3 years, the earnings growth of that portfolio has been 31%. It's a diversified portfolio, whereas the Russell and NASDAQ have been closer to the 10% level. But which one has outperformed? Okay, in this case, when you start to get to flat multiples, you start to actually see that the earnings growth is so high that the performance comes through. And that's what you're seeing. So you're seeing IRRs on that unlisted portfolio of 30%. Now, this doesn't sit comfortably with any of you on your view of Africa. Why? Because no one's close enough to the data that should be measured. But when you have the data and you look at the data, it's looking spectacularly. And those longer term assumptions really are where there's a problem. Now, in us pitching to these asset owners, and I'm sorry I'm going on a little bit, just one more point to make, is we have to look at their liabilities. So what you can do is it's just an actuarial assumption, or a whole lot of actuarial assumptions. And what you can do is you can so there's scheme rules and inflation. You build all this thing in and you get an 80-year cash flow stream. What you can do is you can price that. So we then go and do that, and then we optimize that against all assets available in what's known as an asset liability model, which many of you will know. And it's based on market principles. So what that means is this is all forward-looking. When you look at that, and I just want you to know that when we put in Africa, and the same is true with emerging markets, et cetera, but just dealing with Africa, we hold a gun to the model's head in that the risk that we're using is 45%. Now, for those of you that know modeling, on a 12-month basis, that is pretty insane. It's pretty much like dealing with the gold market. When you do that, what's really interesting is people sometimes forget that portfolios are amazing things. You can take something high risk, add it to something low risk, take 2% of this and add it to this. And what happens to the risk of that new portfolio? It goes down. So when you do these calculations, it turns out that for very, very reasonable American members of pension funds, and by the way, pensioners, for a wide range of risks, you have this 1%, 2%, 3% of Africa creeping in. When you say, look, I'm not cared about risk, I just want return, then by the way, it kicks into Africa and it kicks into emerging markets and all other stuff. But if you just, on a model, and you look for from 0 to 15%, you have this thin sliver. Now, in terms of what you're saying, Hubert, is that 2% or 1% of all American portfolios, if in an optimal portfolio sense you put in Africa, I'm not sure we'd be having this discussion here right now. And so it's a really interesting thing, but people aren't doing the work, and the work is not being done because we all focus on the investment. But that's not really, you want the beta of the investment. You want to take out the excess risk. You hire very good specialists to do that. You use blended finance. All of these things are really good tricks as long as you get a diversified portfolio, because then it actually comes through quite nicely. And that's the important thing, is to look realistically backwards and see what's actually happening, and then make sure that you're pooling in your portfolios to get the right risk dynamics within a total portfolio framework as opposed to one asset.
Okay, now thank you very much, Jared. I think that's very clear. Just for the record, we do want to retire this conversation and really start focusing on actually executing against this scale. And I think that's where I'm going to come to. I'm going to come to Jay now, because when we talk about private capital mobilization at scale, it's still extraordinary to me, at least, that when we're talking about mobilizing these trillions, we're actually, and then these trillions of private capital in many respects, we're actually letting the public sector drive the bus. So private capital mobilization is essentially a domain that's actually led in many respects, at least at the catalytic level, by the multilateral development bank conversation. And when you begin to look at the private capital mobilization ratios in terms of the level of success that the public sector, the MDBs, have had at mobilizing private capital at scale, for every $1 that they finance, they're supposed to be able to mobilize $10 of private finance. And the actual record, as reported by G20 and others, is that for every $1 that they provide, they've only been able to mobilize between 20 and 38 cents. So that's obviously a track record from the public sector about how to mobilize private capital at scale. So I'm going to come to you now, Jay, and see if perhaps you might be able to give us some ideas about how we can improve upon that mobilization ratio, and give, what are some of the success factors that private capital has been able to create at scale market opportunities, and how could that be applied and accelerated for emerging markets and developing countries? So over to you.
Even the question was a mouthful.
Yes.
Okay, so first of all, if I may, I just want to add to what you said about the power of pooling and diversification, because dynamically managed portfolios that are diversified. We went back to this after the financial crisis. That works, and it's a very powerful concept, because when we look at the dramatic need for equity risk as kind of a starting layer, or any risk, diversification helps. Pooled diversification helps. It helps with debt, it helps with equity, and we're going to have a big meeting in a couple hours of the MDC where we're focused on what came out of the Macron summit on FX. Same concept. If you give me a basket of currencies and you want to actually lower the carry, the cost of hedging, if I basketize or pool, I can reduce risk. So this is a tool that's important when you ask that question of scale, because it is a tool in the toolkit, so to speak, that's critical. But one of the ways you've got to get there conceptually, right, is you have to have a vehicle, a facility, or a program above the head of individual projects, right? And that's something that we just haven't seen done. I mentioned in the last session that one of the reasons that we're not blending at scale is that we don't have enough projects. But conceptually, if you could raise billions of dollars of funds above the project level, there are a lot of risk management techniques available out there that we could use even in the private sector. For example, many of you may not know that I have called for, I said 1,000 times, but 100 times, whatever it is, that we need 1,000 times the power of MEGA. That if we're really going to do this, we need to guarantee at scale. And we're not doing that. But do you know that MEGA puts 70% of its risk into the insurance industry in private capital markets? So one thing that we at Citi have looked at, and we did this as advisor to the COVAX facility on vaccines, because COVAX took risk, as you may know, to, on one side, negotiate and purchase vaccines from all the vaccine manufacturers in order to get them to the emerging markets countries. And it was an NGO, right, that had all that risk. So we said, well, wait a minute, you can't just carry that risk. What if some of these EM countries that are supposed to take the vaccines can't pay? We actually went to a consortium of insurance companies that were able to give us a price at speed to insure that side. And I think there's a lot of examples of how we can be much more efficient with allocation of risk. It's interesting, risk has to be placed to where it's held best. And a lot of times the world tries to force the wrong risk into someone who can't take that risk. And if you look up and down the capital stack, I think you're going to speak a little bit about sovereign wealth funds, right? But so sovereign wealth funds can actually take a different kind of risk, and you'll talk about it, but they're very unique in their long duration perspective that someone who's marking to market every day can't take, right? There are insurance companies that, quite frankly, you go to the third floor and you sit down and you talk to the the developed world team about infrastructure, green infrastructure. And they understand infrastructure and can take long duration project risk. But when you say, let's talk about single B, let's talk about Africa, they're no, go to the 7th floor. Go talk to them. So you go up to the 7th floor and you sit down with the EM team and you talk to them. Well, fine until you say, but wait a minute, this is project finance risk. They're like, no, go back down to 3. So we have a lot of things that go beyond the MDBs in terms of how we can be smarter and faster if we're going to scale the ability to take risk. And we have great new players. We have all these climate funds that have entered into the world. We have philanthropic money to bolt to the ODA problem I mentioned earlier, that there's philanthropic money that will actually step in and catalyze a debt for sustainability swap, or actually put a grant in to get projects developed faster. And then finally, again, I've tried to stay away from MDBs because I want people to conceptualize that MDBs are the gorilla in the room of a reform effort to get them to mobilize more and take risk differently, structure products that mitigate our risk. But there are other tools out there. And one of the things I tell ministers around the world every day is you have this project, and it's, let's just say it's hydrogen. And you're conceptualizing and you're sitting down with all these MDBs and the green NGO community, et cetera. But have you actually talked to the top 5 players, global sponsors of large corporates, and asked them to come help develop that project for you in the country? Have them do the feasibility study. Why isn't that happening? Because at the end of the day, those global players take equity risk. They can figure out how to finance it, not on your balance sheet as a government. And they may actually, if you meet them halfway in terms of the enabling environment, they'll actually do the feasibility study for you. So why aren't you talking to the private sector aggressively and proactively about that? And I'll stop there.
No, thank you very much, Jay. I think you've raised a number of points that colleagues are going to come back and share their views on. I mean, just when you talk about the scale of the de-risking and the insurance market, I mean, if you look at, I mean, on average, I mean, it was a broad statement though, but, you know, if you look at an average financing, whether we're looking at the pool of 3 to 23 trillion, approximately a third would require some form of de-risking instrument. So if you look in the African context of a 3 trillion, that's potentially a trillion, of which people are now beginning to enumerate that could be a 500 billion to a 750 billion de-risking financing opportunity. You know, and then when you begin to look at the capacity in the market, whether it's the African Trade Insurance Agency as capacity, that's a $400 million balance sheet. Everything it touches gets reinsured, and it's got a backstop from the World Bank. So that's not really a natural market instrument. And then people say, well, no, well, let's really look at MEGA. But the Multilateral Investment Guarantee Agency, again, is a $60 billion balance sheet, and we're talking about half a trillion to 750 billion. So I think there are real market opportunities if we can just allocate that risk. But to do that, we absolutely need the right type of data, because without the right level of data, we're always going to presume that the risk is higher than perhaps it is, unless it can be evidenced. So that just takes me neatly on to Mahesh, because every time we talk about data and being able to have some kind of insight-driven approach to how to allocate to emerging markets and developing countries, this acronym comes up, GEMS, Global Emerging Markets Database, that risk database that's become proprietary to the multilateral development banks. And we know that there's a GEMS 2.0 project where it's going to be hived out and sort of run as a separate, well, it's going to be democratized to some extent, but we in the investment community feel that it should actually be built out, so that there are better sets of data. So it's not just a reference tool, but it becomes an asset allocation at scale tool. But I suppose your job is to talk about that. So over to you. Microphone.
The panel here with such a distinguished. Is this on? Yeah, it's working. Thank you. So. You know, scale is a beautiful thing. Pooling has been mentioned. Diversification has been mentioned. Those are sort of the magic potions. A principle of scale is a greater disclosure of repayment record catalyzes lending. The disclosure of delinquency and loss data, such as is available at the GEMS database, is critical for scale in climate finance, as frankly in any kind of finance. Similar borrower loan performance data was critical in the buildup of the asset-backed and mortgage-backed securities markets to multiple trillions of dollars. To realize its potential, we must encourage professionalization, disclosure, and use of the GEMS database, which is actually run by a couple of dozen DFIs, development banks like EIB and IFC, but a bit like Donkey the Manger, they are sitting on it. and won't let the rest of us see it. I mean, it's overdrawing it a little bit. They are now beginning to divulge it, but the process that they have is still bureaucratic and needs to be accelerated. AU, not to be outdone, has proposed a model law for its member states to put in the rule of law and improve the business environment and to mobilize scale if it were put in. We were able to catalyze it. And if the asset allocations to Africa, as Jared said, can rise from 1% or thereabouts to 5%, which is the goal of the AU, that could make a huge difference in scale. The AU has also proposed that the investors be granted what's called preferred investor status, which doesn't exist, but it could be put in place, cloning what does happen for MDBs, which is PCS, preferred creator status, which is by practice, not by law. If this can be done without loss of AAA ratings of the MDBs, it would actually help elicit some investors into the market if they have some preferential repayment possibilities. Now, what is data good for? I used to be at Standard & Poor's many years ago, running their international ratings, including structured finance ratings. Well, data goes into the pot, and you store it, and you come out with rating criteria. What are rating criteria? Criteria are the standards in structured finance whereby you set the rules which must be met in order to achieve investment grade ratings. Jay talked about investment grade ratings and how their critical role in eliciting volumes of investment in the earlier panel that I happened to sit in on. Now, those investment grade ratings are determined based on stress tests, but in must come data. There are gobs and gobs of data, sliced and diced every which way about every country, about every sector, about every kind of project going back eons, right? The database in the GEMS system has been collected over 15 years. It's got 33 years of data. The S&P and Moody's and Fitch have data going back 70 years, 70 years, okay? The more data, the better. And you can structure from that asset-backed securities, mortgage-backed securities, you can structure infrastructure-backed financings, you can structure climate financings, anything that moves, all right? But you need data, and we must have data coming in from GEMS to the market, without which we cannot really step forward and do this kind of work in volume without the use of MDBs to the same extent that we keep talking about from time to time. Now, let me show you what can be done. African Development Bank in 2019 relied on only its internal data to come up with a deal to securitize 50 loans totaling $1 billion, pooling, right? Pooling and diversification and scale, $1 billion. Okay, but they had to put up 27.25% of protection under the senior tranches to get the senior tranche to be investment grade. Basic, call it 4-to-1 leverage. If the data had been there from the markets, that ratio could have been increased to 4-5 times or even more. So data buys you greater confidence in the potential for recovery of your investment down the road. That's what we need from GEMS. GEMS database has it has some benefits, so I want to give them credit for having done it. But it has some serious limitations. It is non-public, even for the rating agencies, and the data collection and distribution processes are very bureaucratic. The data, I mean, somebody told me that he sent an inquiry and it took 6 months to get a response because the guy that was going to respond had an accident. So that's not workable. That has to change. It has to be institutionalized. And so to do that, it has to be put on an independent footing and professionalized. A great challenge in climate finance is also for better project development, which Jay has talked about. You can't really securitize or fund unless you have a project. But I'm optimistic on that because $1 trillion green bond market has developed in just a dozen years. So why not? Now we have blue bonds from Seychelles, Barbados, Belize, Ecuador, and most recently Gabon. So these can also be scaled up. The Nature Conservancy is overseeing Gabon and Ecuador transactions and can do many more. So I'm optimistic. Now, credit enhancement is key because there has to be quality credit for those who want quality, and other investors are willing to take risks, so you can segment and then get to the blended finance. Guarantors like, of course, DFC have played in the blue bond market. Others are coming in, like the Green Guarantee Company, and many others from the private sector may also join over time. So as in the structured finance markets, I think initially there was reliance on monolines and bank guarantees, but gradually senior subordinated structures came along, and investor segmentation allowed those who wanted yield to take the lower tranches and those who wanted lower risk and higher quality to take the senior tranches. And of course, cash collateral came in too. So cash from the non-NGO and the Bill Gates of the world and the philanthropies can come in and play a role too. The next step is to go from GEMS 2.0, which is going to give you a little bit of a disclosure, to really a full-blown GEMS 3.0, where you have global institutional investors and rating agencies and others can get access to well-managed, well-constructed, easy-to-access, reliable data on performance in projects and structures over time. So it should complement, expand, and broaden the development of the data sets to mobilize private resources and work with the rating agencies to develop criteria for climate finance transactions. It should analyze the data to provide global institutional investors with the wherewithal to rely on investing with confidence. And it should help enhance asset allocations. All of this can happen if data is available. Larry Fink, who founded, I almost worked with him, I should have. He founded BlackRock, which has $10 trillion in assets. Now he predicted that this market could scale up if we had the following things. First loss by the countries, second loss by MDBs, and then he would come in. But I think that's the first stage of the market. Then come cash collateral, then come senior subordinated transactions, and that's when the market will really scale up. Thank you.
No, thank you very much, Mahesh. I think that's very clear. And the GEMS 3.0 project is definitely one that is being championed by colleagues here at the CFA Asset Owners Council. We think it's going to be a very valuable and transformative project. I mean, just the last two releases, the sort of restricted releases of data from the GEMS database, when analyzed, drew the conclusion that emerging market and developing country governments, by not having access to that database, on average, are probably paying about $15.6 billion a year in excess interest payments on loans. So we think that that's a powerful and useful exercise for the CFA Asset Owners Council. But I think another powerful and useful exercise is to actually have some underlying projects to be able to invest in, which takes us to Guli, who is going to tell us all about the nationally determined contribution projects, the projects that governments have made commitments to, the ones that are always announced during the UNFCCC process and at the big COP summits, last year in Sharm el-Sheikh, this year in Dubai. And we see that as a great opportunity set, a great pool of transactions that NDC Partnership are making bankable. I suppose from the investment community, we also believe that we have the expertise that daily, as our day job, sort of designs projects, finances projects, operates projects, maintains projects, that could be a really good contribution towards the work of the NDC Partnership and others. But let me pass over to you, Guli, to share your views on the investability and the actions towards making that pool of projects an at-scale investment opportunity. Over to you.
Thank you very much, Hubert. Maybe before I share my remarks, just a quick introduction about the NDC Partnership for those of you who are not familiar. NDC Partnership is a global coalition that has over 200 members, including more than 100 developing countries and developed nations, as well as MDBs and UN agencies and other key stakeholders like IRENA, WRI, or CPI, and many others. So the purpose of the partnership, really, the reason it was set up, of course, to help countries enhance NDCs, but a lot of our work right now focuses on implementation of NDCs, which is a very complex and broad process that essentially helps countries to take their NDC targets and translate them into investment actions. So we support countries in developing what we call NDC implementation plans. And ideally, those implementation plans have to identify sectoral priorities and investment needs and lead to the generation and the creation of the project pipeline. We work with the Ministries of Finance and Ministries of Environment. Those are our focal points. There is a lot of, as you can imagine, requests that are coming out from countries about all sorts of climate, finance-related requests. A lot of the requests relate to investment planning work, as well as project development work, and many other requests. So what we have been trying to do, to create that pipeline of projects, first of all, support countries in undertaking a cohesive NDC investment planning process. Because when we talk to the investors, they highlight the importance of a proper kind of transparent and disciplined process across the economy being undertaken by countries in prioritizing projects so that they withstand political cycles and they deliver both development and climate impact. So I think while we do this work on investment planning and creation of pipeline of projects, I wanted to just note three things, in terms of our private sector engagement, which is a key part of our work. Number one, I think countries need to understand the entire value chain because they ask us often to do the mapping of private sector. And the private sector, it's a value chain. You start all the way with your institutional investors, and there are different types. They're publicly owned institutional investors like sovereign wealth funds that Duncan is going to talk about. They're privately owned institutional investors. They also have, different mandates, different risk tolerance. But then you also have corporates that have a vested interest in greening their supply chain that may be able to take more of that equity risk that Jay has talked about and may be able to come in and do more of the project development work. Then you have the whole, supply chain. So I think it's very important for the countries to understand the value chain, and when they do their investment planning and create their pipeline of projects, they really distinguish between the projects that would attract different type of investors and different type of products. And also, pooling arrangements are important because, you have in that pile of NDC projects, you have some, high return projects, you have low return projects, you have high risk projects, low risk projects, you have adaptation, mitigation, hybrid projects. So it's important for the countries to understand how they need to be categorizing the projects and what projects would qualify for what. For example, blended finance, we have been saying that, it needs to scale, it needs a pipeline of projects, but what projects would qualify for blended finance? Those have to be the projects that don't yet have an established business case, but have a potential of commercial viability. So it's very important, I think, to support countries in that process. I also wanted to really commend you, Hubert, and the team for putting forward that model law on institutional investor and public partnerships, because that's type of private sector input that is needed as we support countries in developing enabling environment, really understanding how can the processes of identification, prioritization, procurement and development could be streamlined and supported by the private sector. So I will stop here and happy to chime in later on.
Thank you very much, Guli, and we thank you for your partnership as well. I think it's taken a while for governments to appreciate how willing we are to help them sort of alleviate this project preparation burden. Because we do that in the private sector, the companies are doing that, developing projects, and I think through that type of partnership, we can really accelerate the pipeline to get to the scale that we need. And talking about the scale that we need, I'm just going to close out now with our last three asset owner speakers who are really going to share how the industry is coming together. Again, we talk about the multilateral development bank sort of community. Well, that's a collective $1.5 trillion balance sheet when you conglomerate them all. But now when you start looking at asset owners, the sort of the bigger, broader institutional market, that's between 150 trillion. So just by its very existence, its scale. So this part of the conversation is really just going to hear some perspectives from three esteemed colleagues, just about how the industry is positioning itself to really provide leadership. And it's an extrapolation. I think we just want to make this little point of distinction. The global financial architecture conversation is a very important one, and that reform agenda is critical. But within that overall agenda, there is this private capital mobilization piece, which I think is the piece that the asset owner community have identified, that if you really want to mobilize public sector capital, if you want to mobilize public capital at scale, it's probably not best to speak to the private sector about it. So you'd ask the public sector to address that. So if you're talking about mobilizing private capital at scale, it's really asset owners, institutional long-term investors that are best placed to provide input, leadership, and guidance on that. So I'm now going to turn to you, Pedro, to just give your views, as the UN Joint Staff Pension Fund, and of course working across, on a horizontal basis, lots of asset owner groups, about how you believe the asset owner community are and can provide more leadership to close the investment gap at scale in emerging markets and developing countries. Over to you.
Thank you. And everything that you have said, guys, is very useful, and I will try to incorporate I will give you in 3 minutes the one day in the life of an asset owner, right? And
only 3 minutes?
3 minutes. Very brief. And correct me later, guys, if you want to add anything. First, who are we, not the asset owners? It's institutional investors, pension funds, insurance companies, sovereign funds, and endowments. But that's basically what is called asset owners. And we are mostly public or public-like, right? Which is very important to hear. Now, how do we work? We, going back to models, every once in a while, 3 years, 4 years, 5 years, depending on your business model, but we do an asset allocation study. And we hire the usual suspects. It could be Ortec, it could be Aon, it could be those organizations that help us, and we all hire the same ones, the 4 or 5 ones. And those guys, based on benchmarks generated basically from 2 of your sponsors here, MSCI, S&P, Bloomberg, based on those benchmarks, they recommend the best asset allocation that will generate the best risk-adjusted rate of return in the next 30 years. So that's what we do. And then with that, it says you can invest only 1% into emerging markets debt and probably 5% in public equity in emerging markets. And on private markets, they don't even say that, right? But they give you, follow this benchmark and follow that. So, and I'm pointing out here players, right? Players that if we want to get to size and scale, those players are important because, again, those guys, those 4 or 5 Aons, Ortex, all those guys are determining the asset allocation of most of us, following the benchmarks of those 3 or 4 companies that are creating the benchmarks. And now we go and implement, right? And we have different business models, but we basically are benchmark hoggers, right? Because remember, we are, and we like to pretend that we are active managers, right? But we take very simple bets around the benchmark, right? So again, the benchmark has very small allocation to emerging markets. Why? Because our staff, going back to we're public civil servants, most of us, we are not incentivized to deviate further away from the benchmark, right? So all the system is generating a behavior. And then when it comes to private markets, again, we are benchmarking ourselves to a benchmark that has a very small allocation. And then we have very small teams, all of us, very small teams. And then you have to deploy, let's say, $1.5 billion a year on private equity, right? And you can do it in 4 or 5 transactions, no, at a ticket size of $250 million. Or you can do it in 20 different deals that will take you 20 times the amount of time and 20 times the amount of effort and due diligence. No? Guess which one they would do, right? So, and we get bombarded by all the large GPs offering billions of dollars of funds, and you can fill your allocation in 5 deals, or being bombarded by hundreds of smaller GPs that don't follow into our rules, because what we, in the rules for selecting GPs, we say 3 years of experience and good performance and the team that has been there forever and the founders and the this and the that and the that. So the whole system is skewed for size, for scale. And we're not seeing that happening. No, you have explained why. You know? There are no projects. There is a lot of capital ready from all of us. You said the number, 1 point something trillions of dollars. We all want to be sustainable. We all want to invest in this type of projects, but looks like there are not many projects, no, or they are being generated on the pipeline, but they are not there. And second, they're not being brought to us in a scale enough so that we can even process and think about investing on them. We cannot invest in funds that are less than $1 billion, right? Because, and we will ask the other asset owners, but my private markets team, they wouldn't pick up the phone for a ticket that is less than $150, $200 million, right? So that, and we cannot invest more than 20% on a particular fund. So that makes it funds larger than $1 billion. So you have to have a lot of projects that are vetted and that you have already structured that are attractive and we can invest in them. So what I would propose as an idea is we have to work on those actuaries, no, the Aons, the Ortex, to change their models. Second, we have to speak with the benchmark, with the benchmark providers, the MSCI, the S&Ps, the Bloombergs, all those guys, because there should be space to do it, right? You were talking about the blue bonds and all those guys. They are not in the benchmark. So something has to happen. They have to be included in the benchmark. They have to create a space so that our investment officers on the day-to-day, they want to invest there. And then something has to happen in the private markets sphere. There cannot be so many, right? There's no space for hundreds and hundreds of GPs that are just fragmenting and not channeling the capital that it's available from us that should get to the place. And then, of course, there have to be projects that are bankable and attractive to all of us. So I hope that it helps.
No, very helpful. I think we've all got our work cut out. I think the market's got its work cut out. But I think it's changing and it's evolving fast. If you look at I don't know, the continent and mobilizing, climate finance and private finance. Gone are the days when we can turn around and say, show me just a pipeline of projects. And then we can think about making an allocation against that. We're now looking at a situation where we're saying, okay, show me how investing in your portfolio of opportunities is better than investing through the Inflation Reduction Act or investing through the Net Zero Industry Act. In other words, there needs to be a high degree of incentivization for the asset allocation decision. So I think absolutely we've all got our work cut out. And now let me quickly move to Eric from CDPQ.
Thank you, Hubert. I'm going to focus my remarks on a slightly different aspect of risk than we're used to speaking of. So all of us so far have mostly spoken about the financial risk elements and the challenges for private capital mobilization. But there's another set that is equally important, and these are the non-financial risks. So for us as a pension fund, if we want to invest in emerging markets, Africa or wherever, assuming we get all the technical stuff right, we get the de-risking capital, we figure out how we're gonna manage our FX risk. There's a pipeline, we have the data. We'll still need to go to the investment committees, the representatives of the depositors, and win their approval. And they're gonna ask us about things that have nothing to do with the financial elements, because they're gonna assume that those are taken care of, or we would never even be there in the first place. They're gonna ask us, well, how are you protecting against reputational risk and political risk, and these other non-financial risk elements? And it can kind of be summed up as a simple question. If something goes wrong, who are you going to call? You don't know these markets. These aren't your home markets. You've never been there before. How are you going to fix a problem if one emerges? Because no matter where you invest, whether it's in Montreal, in Manhattan, or Mozambique, things go wrong, right? If things didn't go wrong, there'd be no risk and there'd be no return. And so they're often interested in knowing, what's your plan for solving these problems? And it's a challenge, to be honest, because for most of us pension funds, we don't have long-standing institutional relationships with either the governments or the private sector in a lot of these countries. And so that right there is the issue. So how do we go about trying to solve that? So let me draw on SDG 17 and the word partnerships, because I think that's the way to go. And I'll look at 3 or 4 kinds of partnerships. One is with the governments themselves. So I really think, and you were asking in the note, recommendations for heads of state. I think one is, it'll be very important for the governments of emerging economies to do more, and conversely for the institutional investors to do more to try and build direct relations with each other so that they become familiar with each other, learn each other's language, vocabulary, priorities, and build that trust that is needed over time to feel confident to deploy capital at scale. So that's one. Other kinds of partnerships. I know we're not really supposed to talk about the MDBs, but I will a little bit. The multilateral development banks have presence in every one of these countries, and they often have very well-connected resident coordinators who have good government relations. But it's not just the MDBs, the UN too, for that matter, right? The UN have resident coordinators. So getting them involved, they might not always be able to provide financing, and the UN essentially never, but they can help provide, political risk mitigation. If I can tell my depositors or my investment committee, yes, the UN has skin in the game. If something goes wrong, I do have a 911 I can call. I can call the UN resident coordinator in country XYZ, and he or she's on the case and will do the best they can to resolve this issue. That will go a long way. And then there's partnerships amongst us, the investors themselves. So again, if I'm presenting, it will help if I can say, hey, we're investing with Citibank. We're investing with these big institutions. That will give, the representatives of, Quebec firefighters confidence that, we're not messing around. We're going in with serious players who know what they're doing. So that kind of partnership, and find, partnerships with the donor governments. It will also help if I'm able to say, oh, we're not just investing by ourselves. We're investing with, Uncle Sam, the US government. We're investing with Japan, with the UK. All of that will help overcome what's essentially almost psychological barriers to wanting to deploy money to markets that people are unfamiliar with. And I think that's an important element of these conversations. Thank you.
Fantastic. No, absolutely, an extremely important element of these conversations, and we would absolutely, and we do applaud the work of the African Green Infrastructure Investment Bank, because that's anchored on the premise of giving you a talking point, for example, to be able to go back to your depositors in those investment committee meetings and saying that we are also investing with the local institutional investors on aligned terms in the market, which gives you that sort of skin in the game from the local market, but it also gives you that quasi co-investment linkage into the government. So absolutely, there's another talking point there, and that's actually happening in practice. So that's wonderful. So let's just close out with a representative that sort of talks to that same constituency, the local sovereign funds who are that perfect partner in these types of situations, subject to alignment being established through institutional investor-public partnership. So over to you to close us out, Duncan.
Okay, and I'll just take really just 2 minutes to say a couple of things. And the firstly is to emphasize a point that's been made about risk. This is all about getting the appropriate return for the risk that you take. Now, sovereign wealth funds are long-term, or they're savings funds, they're long-terms, they're contrarian, they're patient capital, and they can accept illiquidity. I was talking to a fund the other day, hasn't got its first payout until 2080. That's its time horizon for liquidity. So it can take that on long-term illiquidity in an investment at the appropriate rate. But then and that's a clear point about risk, that has to come down. And I think it was Jared mentioned risk and 40% in terms of a plan, and that's the result that you get. But all actors need to be aware of that. So one of the ways to address that is a number of sovereign wealth funds actually have skin in the game in their domestic markets. They're called strategic funds. Now, they recently met in Africa and Rwanda, and what they're trying to do is actually at scale is put together, and there are other institutions like Hubert's green infrastructure investment, but they're trying to put together those projects at scale and de-risk them at a governmental level by having a government-sponsored fund that's actually involved. So that way takes out some of that broad political risk. And of course, they're populated by people like yourselves who've got experience of markets and what's required. So that is going on. So there is active work, and the point of that, there's a good example of this in India. NIIF established a fund. The Indian government invested in it. It established a proper portfolio of investment. It established a whole private equity approach, and that's actually owned by 2 sovereign wealth funds, or at least in part, ADIA and GIC. So there are good examples that work. And then the final point I'd make is really to people in this room as much as anyone else. Somebody mentioned the green bond market reaching a certain amount. Now, it's clear that there's demand from investors for these kind of investments. However, if in that market there is greenwashing and they're not real investments, A, it takes money away that could potentially be invested in developing markets, and B, it sours the reputation for everybody in terms of that. So my plea to you would be make sure you keep a strong eye on that and take a stand if you see something that you don't think is appropriate.
No, thank you very much, Duncan. Well, that just brings us to an end. I think we all have our homework set out. I think we're a sort of a multi-sectoral, multi-constituency audience here. So hopefully you'll be digesting not only the food at lunchtime, but a number of these thoughts, and hopefully everyone on this panel will be available to mingle with you, because we're up on time. So your question and answers will be over a discussion at lunch. But thank you for being such a great audience, and please join me in congratulating our panelists. Thank you very much. The session is closed.
Thank you so much to all the panelists, and we'd welcome everyone to have lunch at this time. Thank you. take your seats. Please take your seats, those who are still over at the food area. Okay, we're going to begin with Deepika Sharma is going to introduce the panel.
Just about the light in here in a way that I
Should we turn our mics on and off in between comments?
So, no, do leave them on. They will only take sound, basically, from
Saudi Arabia.
As you
Get right up in person. Oh, and there's one. Okay.
Well, good afternoon, everyone. For those still in the lunch section, I would encourage you to come back as we are starting the afternoon sessions. My name is Dee Sharma. I am the Global Head of Manager Selection for BlackRock's outsourced CIO business. It is my pleasure to introduce the panel, which will focus on asset classes, ESG impact, and regulation trends. Would like to introduce Joyce, who is sitting at the far left, who's going to be moderating the panel. Not an envious task, Joyce, considering it's after lunch, but she's the CEO and president of Adgenura Advisory. She's a global leader, supply chain expert, currently serves and has a history of serving on multiple boards, and has built on solid experience in boards and governance. Next, I'd like to actually introduce Juan Veron, who's on the screen here. He's joining us from Principal Financial Group Mexico, where he's the Chief Investment Officer and getting close to his 10th anniversary as the CIO. Congratulations in advance, Juan, and he brings 25 years of experience in investments and finance. And then continuing here, next to Joyce, we have Ariel Nicholas, who is a climate solutions specialist at MSCI, a late addition to the panel, but great addition to the panel, Tony Berkeley from FII Institute, who has executive experience at global for-profit and nonprofit institutions, having worked with Prudential Financial in impact investing, as well as with the W.K. Kellogg Foundation. And last but not the least, Samantha Hill, who is a leader in sustainable investing at one of the largest asset owners in Canada, CPPI Investments. So with that, Joyce, I'll pass on to you to kick us off.
Thank you so very much, Dee, and welcome to the Stay Awake program, because it's coming right after lunch. So let's not eat into our time. Thank you for those introductions. And a general question. What is your view about ESG, sustainability, impacts on shaping the different asset classes? Let's kick that off with Sam.
Great. Can everyone hear me? Wonderful. And Joyce, did you want us to each give like a very tiny recap of our organizations, just in case people aren't aware?
Please, go ahead.
Okay. Just for those of you who have not had the chance to meet yet, Samantha Hill. I'm a member of the global leadership team at CPP Investments and a managing director in our sustainable investing team. And I've been with the organization for just over 16 years now and always in that capacity. So CPP Investments is the largest asset owner in Canada, managing just over $570 billion in assets under management Canadian and investing globally across all asset classes on public and private side of things. And so that's a great segue then, Joyce, in terms of, what does that mean in terms of thinking about ESG considerations, or what we've moved to referring to as sustainability considerations across asset classes. And maybe this is something you all will want to debate with me, but at the end of the day, my view is a company is a company. And that is absolutely an oversimplification of what needs to be considered. But if you think about the framing that has been developed around, the very thoughtful and pragmatic framing that's been developed around sustainability factors as it relates to SASB, now ISSB, in respect of the sectoral view of what is material, what is financially relevant, what is decision useful as it relates to that sector level. There is absolutely, cross-application that is relevant between public and private markets. The nuance, I would say, is just around the level of expectation to some extent, but also the nuance is at the company level. So great that we've got these sectoral, roadmaps, guidelines to work with, but then it really does matter, where is the company, where is the company operating, what are they doing, how you think about it at the sector level, but the geography, like it really matters to come in there. And then from an investment perspective, an investor's perspective, there is an aspect around horizon and also liquidity. And so taking those things into consideration as we're looking at, due diligence on a company, but also asset management, monitoring, and even to exit, all of those things matter.
Thank you so much, Sam. Juan, please introduce yourself and respond to the question from a product innovation viewpoint.
There have been a lot of things happening right now. And one of the key points that we are not in a homogeneous world where the trends are coming at the same pace. Now we are, in terms of regulation and product development, in a multi-speed world with Europe and Asia coming very strong in terms of product development, trying to catch the 2050 net zero and nowadays the reduction in emissions by 2030 by 55%. United States is moving, and I would say has been much more shy. There has been some tailwind for the regulation in the ESG lately. Therefore, the product development is coming, I would say, in three main fronts. The first front, I would say much more in the region in the Americas, are related to supply chains and reshoring. We are seeing a lot of things happening, particularly in geopolitical effects, how it is affecting the reshoring in the United States and how it is affecting the nearshoring in the case of Mexico. And also it's affecting Canada. From that product, we are having a lot of things in terms of rebuilding the existing assets and how you are transitioning in those assets. And then it comes the second point that I consider very important in terms of development, that are the transitioning things. In the case of the transitioning things, we have infrastructure, we have clean tech, we have the circular economy, and the sustainable energy. In those fronts, particularly in the infrastructure, it is high importance from the perspective of mobility. There has been many things happening around, and that is much more focused on what type of battery we want, what type of car we want, and how is going to be the new transportation model. Then regarding the other two related with clean tech, there are a lot of that we are seeing in terms of green energy. The transition is requirement how to move to a low carbon economy. That will require reshaping some existing carbon-based power plants in order to make much more sustainable from other perspectives. And then the third point that is taking an important role after what we have seen the last couple of years is related to climate change. In the case of climate change, we are seeing an emerging trend that is from the perspective of food insecurities. Particularly in the case of food insecurity, we are not seeing much impact in terms of developing market or emerging market, but in frontier market, we are seeing some hungers. And so we are, the SDG number 2 is taking an important role in terms of product development. We are seeing many products on that front because the food insecurity is coming stronger due to the drought and the floods, and also with a higher level of inflation that we have seen in the last couple of years. And in the case of climate change, it also comes many things related to what is from the perspective of the new energies and how it will be in some way trying to offset what happened and trying to affect what is the case of looking for a net zero. And the other point is related to the 1.5 Celsius degree top it is under discussion nowadays. But I will say that these are the three pillars with derivation that I mentioned.
Thank you so much, Juan. Let's turn to you, Tony. Where are you seeing the impact of this drive to ESG sustainability impacting different asset classes?
It's a fantastic question, by the way. And I just want to thank Tom Burgandy at CFA Society for this opportunity to join you today. I'm not a CFA holder. I'm a PhD, not a CFA holder. So I do relish my opportunity in this community. And just want to acknowledge the global CFA for building intellectual community around the certificate. That's been a move in the last 5 or 10 years. I've done podcasts, et cetera, and it's phenomenal. The entire set of offerings are tremendous, and today is a good example of that. So I'm very pleased to be here and happy to be a late addition to this panel. I want to answer that question in personal terms, but let me just set the stage first. So I'm the head of investment at FII Institute, and that may be an organization that's new to some of you or many of you. We're a newish nonprofit foundation and think tank that was formed in 2019 by the Sovereign Wealth Fund of Saudi Arabia, the Public Investment Fund, formed as an independent nonprofit. So we have board representation from the governor or the lead executive of the sovereign, and everybody else is an independent board member, including the former prime minister of Italy and other such luminaries. We're supported through sponsorships with global corporations. So we meet that independent funding test, we meet that independent board test, and that's important for what we do. We're most well known as the host and convener of what's called the Future Investment Initiative. Can I just poll the audience? Has anybody attended or heard of the Future Investment Initiative? I know my good friend Ted has, a friend over there, a couple of folks. Okay, this is the largest investor conference apparently you've never heard of. It's held annually in Riyadh. It is the largest such conference held outside of Europe and North America. Our peer group is Milken Global Forum and the World Economic Forum. And what's important about this event is that it's held outside of the United States and Europe. It provides a more truly inclusive global and global South-based perspective on the markets. We do have participation from all the capital markets leaders, including all the CEOs of the investment banks that are based here in New York, all the Tier 1 financial media. And so for 3 days at the end of October 24, 25, and 26, all the reporting is happening out of Riyadh, and indeed the capital markets focus on Riyadh. So it's an exciting event, and we wanted to be known for more than just our events, so we started this nonprofit foundation and think tank, and we have a very well-regarded think tank which produces original research on compelling social and environmental issues. And our goal is to get that research, get the best of what we know into these conversations so it can properly influence the decision makers about the future of technology and investment. And then I lead an investment strategy that, in our minds, it's meant to put some action behind our words. So we have a direct investment strategy in early stage deep tech, where the solutions are aligned to our institutional priorities, which themselves reflect the Sustainable Development Goals. And then we have a thought leadership mandate that came directly from our board to encourage the global ESG and sustainable investment community to do more investing outside of Europe and North America in emerging markets. And so we've developed thought leadership positions around what we call inclusive ESG, and we've developed a portfolio of direct investments in high impact, early stage technology companies. So that's the background for my comments. For me, this question is personal. I'll tell you why. Because I was fortunate enough to have the opportunity to work with FII Institute three years ago, almost to the day. And I faced a tough decision. I was working here in the city with Prudential Financial on their impact investing team. My wife and family are in New Jersey. And my wife and I looked at each other like, well, do we want to do this? What would be the reason to do this? And fortunately, my kids are a bit older, so we were in a position where we could even consider it. And what attracted me were the two big challenges on the investment side of FII Institute that I think speak to how I view the personal responsibility of anybody who wants to consider themselves an impact investor, an ESG investor, or a sustainability investor. And you have to be doing one of two things. You're either a pioneer and you're pushing your markets forward, right? You're finding boundaries, you're developing strategies or investment structures that aren't mainstream, aren't plain vanilla, right? That's what I'm doing in that direct investing portfolio. We're really taking on this issue that, you know, institutional investors can't do more early stage deep tech outside of AI, Ted, outside of the groupthink of VC. So we're really pushing that envelope, and we want a proof point to influence other larger investors to do more of that kind of investing. Then on the ESG side, we're taking on, I think, the other main challenge that all of us need to be working on, which is how we can really accelerate the mainstreaming of this kind of thinking and these investment strategies so that even today, there are, what, $1 trillion in impact asset management. I mean, Morgan Stanley's recent report put the sustainable investing universe at $3 trillion in terms of managed funds, well below the larger numbers that sometimes are kicked around. So these investing universes have not really scaled to the level that we hope they will. And that pushing, that institutional pushing in these mainstream asset strategies to really drive up the AUM is I think, the other main challenge. One more comment, and then I'll stop. Can I just make one quick comment? Okay, so I'm very sorry about that. Thank you for letting me ramble a bit. What we're excited about at the Institute are listed equities in emerging markets. Why? Why might you say listed equities in emerging markets? Well, listed equities in emerging markets reflect markets where we have 90% of the population, 58% of the GDP. These are thriving markets. There are thousands and thousands of listed equities, many of whom have much stronger sustainability and ESG track records and reporting and performance than the broader investment community really realizes at this point. And so in some ways what we're doing is we're becoming a part of the effort that MSCI has led for so many years, FTSE Russell has led for so many years, of providing tools and toolkits that can help investors who are all largely based in the US and Europe to consider ESG and sustainable investing into a traditional, large cap corporate kind of strategy, but to do it outside of the markets that we're most comfortable in, and to really focus in on these emerging markets where this type of investor and this type of mandate can, I think, find interesting opportunities and have the largest impact. Again, trying to move the big picture, even while we invest and try to push on this more specific early stage direct investing strategy in our own portfolio.
So thank you very much, Tony. Let's give Ariel an opportunity to talk about this issue from a data provider viewpoint.
Sure. Thanks, Joyce, and hopefully everyone can hear me. Some big resumes to follow here, but I'll do my best. My name is Ariel Nicholas. I'm one of the climate solutions specialists at MSCI. And for those of you who are not familiar with MSCI, we're a global data and solutions provider. I see a lot of nodding heads, so it sounds like everyone's fairly familiar. We range in solutions from analytics platforms, indexes, real assets, data sets, as well as ESG and climate, which is where I sit. So in my role as a climate solutions specialist, I work across all of the client segments, ranging from asset owners to the managers, down to wealth managers, and pretty much everybody in between, to make sure that you have access to climate data points that can be helpful and applicable to your own climate data objectives and goals, ranging from net zero commitments and tracking that progress, investment and risk insights to go into portfolio construction, and again, everything that comes in between that. So it's great that we have these panels today, because as new drivers around climate integration are coming out, regulations, frameworks, investment approaches, it's important to be able to speak amongst data providers, the practitioners, where those best practices come in. So then to that point, to answer your question around asset classes, first off, climate is a systemic risk. All asset classes, all companies, all sectors are exposed to this as a risk. And again, thinking back to some of those key drivers, why are we talking about climate risk in the first place? Regulation. We're seeing regulation being enacted, especially out of Europe. We're seeing CSRD, SFDR, MiFID. How does that then translate into other regions? The Asia-Pacific region is starting to come out with more regulations. Canada and the US, there's a number of pending regulations. And in fact, California, where I live as a state, just passed their own law around climate disclosures. So we need to start following those, and we are starting to see investors shift their approaches to meet these new regulations. New frameworks are coming out. So how are we responding to UN PRI or net zero alliances and the multitude of expectations from those alliances? TCFD frameworks. And then finally, thinking about risk management, climate as a risk insight, and then how does that parlay into the asset class exposure? So climate risk is a very long-term risk. all of the asset classes are going to respond and behave very differently to that risk insight. We have to look at equities and bonds and real estate and private companies very differently. We need methodologies that are very specific to those asset classes. Equities, we know, are highly sensitive to macroeconomic environment, to regulations. Bonds, we're looking at short, medium, and long-term horizons. We need to have risk metrics that match at each of those horizons so we understand where is that bond valuation going to adjust or where is that bond not going to be able to repay on its debt, looking at things like probability of default. Real estate, if we know that our property holding is for 10 years, what's that climate risk exposure over that 10-year holding period? But then going beyond, what happens at the resale value? How is that property's valuation going to adjust now that something like a physical risk has impacted it, or we know that something might happen? I could keep going on and on about asset classes, but I think what I'm trying to say is it's really important to delineate out each of the asset classes and have data and solutions that match and are really specific to each one of those.
Excellent grounding for my next question. As a corporate board director, and having operated in the ESG and sustainability space, companies are asking questions inside the boardroom about how does this fit into our business decisions. One of the things that is widely known is that how ES and what our corporate governance looks like impacts different economic classes in different ways. Hardship for past redlined communities in the US comes to mind, for example. How are you thinking about this for the different asset classes? Not only equities, but there are cities and towns now issuing bonds on how they're managing their energy, how they're managing their wastewater. Talk a little bit about that, and let me start this off with your thoughts, Sam.
Yeah, thank you. I mean, I think there's maybe the one thing that we all touched on at the first question but didn't really get into is just the opportunity that there is around all of this, and that is something that I think that's what you're seeing in terms of why these vehicles are emerging, because it's clear that in isolation, governments can't move these things forward on their own. And that's maybe just one of the things that I'm hearing most so far over this kind of day and a half into Climate Week, is that there is a bit of a level of frustration amongst that not all being figured out in terms of the ecosystem that is needed to enable all of the capital flows to be there and these opportunities to be realized, because there is a massive recognition across I think public and private markets, public government, private sector, in terms of how that all gets enacted. And I mean, to your original point, Joyce, like these have real implications for individuals, right? And to functioning economies in terms of, looking at it from a pure play investment perspective, the growth profile and the desiredness in terms of, what's it like to live in a given environment, let alone work in it. And so these are things that we think through in our investment analysis and our monitoring, and, how is this actually going to play through and impact what that growth and stability profile looks like over time.
Juan, your perspective from Mexico.
Basically, here what we are having is a perspective that it is coming with a lot of activity from the perspective of the corporates. Companies are doing a lot in terms of issuing bonds, and certainly this type of bond has come in different form, in different ways, and many of them have come probably with some futures that may not be the most suitable, but it has been a really wide market that has been open from the corporate bond side. From the perspective of the government, we have not seen much happening from issuing new bonds or issuing new standards or regulations related to the capital market by now. From the perspective of the state and municipalities, we have not seen a material change on that front. So net, what we are seeing is an important movement from the perspective of corporate bond issuance, but not from the government. And regarding from the private assets, we have seen some activities, but that are coming at a lower extent compared to what is going on in the corporate bond market. What we are trying to do as an investment manager is trying to look for much more transparency and much more disclosure from the companies. That is really challenging in an environment where the government is issuing new regulation, but it's not coming at a strong pace. Therefore, we are trying to improve the communication with the boards. We're trying to improve the communication, providing certain questionnaires that are aligned with global standards. But that is really the main activity. I think a lot of things will be coming soon, and there will be a change in the administration next year, and that probably pave the way for further innovation in the capital market from the perspective of the government particularly.
Thanks so much. Ariel, your perspective?
So I'm going to come at it a little bit differently from a climate and data perspective here. First off, yes, climate is going to unjustly and disproportionately affect different regions and economies. And our goal as a data provider is to get as granular as possible to better understand what is happening in those specific regions, in those specific municipalities. But I think first and foremost, it's important to see what is the data actually trying to accomplish. And when we think about climate data, we look at it across two core components, transition risk and then physical risk. Transition risk of understanding what are the regulations, what are the policies country by country, and how is that going to force companies to decarbonize? What are the cost implications in that? We're also going to look at technology opportunities. So Sam has mentioned there's going to be opportunities around this transition. How are some companies already poised to benefit from this, and where is that going to take us in the future? And then third and finally, looking at the physical risk. We know as the world warms that the extreme weather events, these hazards, things like wildfires or hurricanes, are only going to increase in severity and frequency. Now having that data, now having that understanding, company by company, country by country, this can give us better information to work off of. So from MSCI's perspective, our goal is to provide complete, full coverage across the global opportunity set. And knowing that, we can then make better and informed decisions. From an MSCI company perspective, we've taken those data sets and we've applied it to our own company practices. We practice what we preach. So we put this into our TCFD reports. And MSCI, as a global company, we're operating in Singapore, Hong Kong, Zurich, New York City, London. We want to know what that exposure is to this climate transition, to those physical risk events. How are we going to safeguard our own company? How are we going to mitigate away from some of that risk? And what does our go-forward plan actually look like? So every year we publish our own TCFD reports and make sure that we're keeping up to date with not only what's our current climate exposure, but where do we anticipate that to come in over the next few decades? And that same concept can be applied through a portfolio and investment practice. So that's the data sets we're putting out.
My interest, just to go a little bit, push you a little bit further, is how's that influencing how you operate in the different geographies to make sure that you're not skewing towards or away from lower income communities, et cetera?
Sure. So while we haven't directly said it, there's this concept of the just transition. How are we going to start tracking where maybe some of these underrepresented communities are coming in? And there's a stat out there, and I think Tony had alluded to it before. Emerging markets, they are the lowest as far as the emitters, and developed markets are the highest, and they're disproportionately going to be impacted. This is absolutely something that MSCI as a company, other companies are really trying to track and monitor to make sure that we aren't maybe exacerbating this issue as it stands. So it's something that we're making sure to constantly monitor, especially in our offices where we are in emerging markets in these underdeveloped regions, to make sure that not only our MSCI population, but that the rest of the community is not being unjustly suffering from this climate change issue, but making sure that we're putting these insights and data sets into the appropriate hands so that this role of capital can really play its necessary role to actually transition our world in the proper ways.
Awesome. We've had previous panels today, one very full stage talking about scale. Tony, can you talk about how we bring practical portfolio ideas to play into this at-scale thinking?
Thank you for that. Just want to acknowledge and underline what Ariel just said. MSCI is a purpose-driven organization whose mission has long been to drive investing into emerging markets, and quite successfully so. And FII Institute is building on that and providing additional toolkits that investors have told us that they want. And that's part of our answer to the scale question. So the Institute worked with Ernst & Young last year, and we worked with their climate change practice, which is based out of London. And we worked with one of their leads there who, the many projects he's led over time, he helped develop the SARA's Climate Action 100 Plus Index, which has been a very influential index for driving capital to the leaders in sustainability in the corporate front. And we worked with him specifically around this issue of a purpose-built, emerging market-focused framework and scoring methodology that could take the current ESG ratings on the market and really grind them in the realities of quite different markets, right? So SASB, right? I know people have been around when that was formed. I know I was. That was developed from a regulatory perspective for the US, right? It's great. It's the basis of the ISSB, but it was a developed market perspective on these issues. And what we found is when we dug in is that there is a way to use those frameworks and those KPIs to tune them into the realities of emerging markets, to be sensitive to scoring and the methodology that will provide a level playing field for these emerging markets to emerge as attractive investment opportunities for the most discerning sustainability and ESG investors. And it's a toolkit. What we were told was, we love the existing tools on the market, so the global investors. It's our first cut. We use it. And then we have our spreadsheets and our homebrew, and we go deep, which is great, right? It's how investing gets done, but it's also a barrier to scale. And if you're not in one of these shops that has a couple really, really smart analysts that built out these macros, right? You're stuck, right? You're stuck with tools and data that you probably can't manage, certainly not at the portfolio level, maybe at the individual investment level. And so we've created a toolkit, which we'll be bringing to market shortly. We partnered with a leading data analytics provider in the sustainability space, which takes that framework and methodology, automates it, uses all of their data, and really turns it on the 2,300 largest corporates in emerging markets to provide these investors a different view of those markets, one that's grounded in the data. They can go back and look in each KPI and each datum, exactly where it comes from, all the way down to a picture of the report from the corporate that generated the initial data. So it gives you all that granularity that you want. You can disaggregate it. And for me as an investor, I just think, oh, wow, this is the tool I really want so I can dig into something and really understand what's driving, for example, a corporation's sustainability reporting or even its ESG score. And the hope then is that large investors will use these tools, use it in complement and conjunction with other tools on the market, and really begin to get over whatever's holding them back today and do more ESG sustainability investing outside of their backyards. And we think the time is right. World Bank, UN, all these agencies are really calling for this now. The long-term perspective is one that these investors follow, and it's favorable for investing in these markets. And so we think this is a great opportunity to kind of shift these flows in some fundamental fashion and really create a more level and truly inclusive set of global markets where strong corporates, no matter where they're based, can be evaluated on their own terms and can attract this investor type.
So, Sam, you told us a bit about your organization and the large amount of funds that you manage, and that panel about scale pointed to the need to connect institutional investors to tools and the ability to blend, to up the value actually of portfolios by including more emerging markets assets in the portfolios. Talk a little bit, please, about where your organization sits in terms of doing more, because you can have greater impact when you do more.
And Joyce, just to clarify, in relation to the current state of disclosure and information, or what we would like to be able to do, or maybe both?
In the interest of time, pick whichever you feel most comfortable
Very
about,
quickly.
because I've got another
The
question.
short answer is that the data is not there and of the quality that we would like it to be in terms of how these things can really come into a fundamental analysis consideration. And, you know, ultimately at the end of the day, what are the linkages between sustainability factors and the financial drivers that are relevant to the businesses that we're looking to invest in or invested in? And so anything that is emerging that can help do that on a greater scale and with greater comparability, because that's part of the challenge as well, then that absolutely helps us do our day jobs better. I mean, one of the ways that we also consider that is by having a more local presence globally. And so that's also just a way that information, you know, we can make sure we have access to it, we have access to management teams, we spend time with our portfolio companies. And so although we are a Toronto headquartered entity, we have offices in New York and San Francisco and London and Mumbai, in Sao Paulo, in Hong Kong, in Sydney. So that is, there's nothing to some extent that will ever replace that in terms of data availability, but the data component is really critical, including to identify the opportunity sets around all these things that we're talking about.
Thank you so much for picking one and giving a robust answer. Before turning to Q&A with the audience, and I'll give each of you the opportunity to respond to this, but how many more years do you think it will take before ESG or sustainable investing will become a best practice across investing? In other words, I see the roads converging. How quickly do you think those roads will converge? Ariel?
Sure. If ESG has taught us anything in the climate space, it's totally integrated. We're now seeing this as a risk factor that's used alongside traditional risk metrics. And if we're looking at Europe, who has really started to lead the pack when it comes to ESG and climate investing and best practices, it is now synonymous as traditional investing, having ESG, SRI, climate considerations, whatever you want to call it. It's another data point that goes into the investment and the risk process. What's the time frame? That's $1 million question.
Come on, you've got a glass ball.
Without getting MSCI into compliance issues, I would say probably in the next few years. I think regulation is starting to force our hand. We are going to have to start seeing more data and disclosures coming from the companies themselves, from the investors and the practitioners of how they are integrating this. That is just going to start becoming synonymous and one and the same for us soon.
Thanks for that. Juan, what does your glass ball say?
Well, here probably in emerging markets we are coming slower, but I don't think that it will go. We are far from that. We are pretty close in terms of what is going on. There could be some headwind in some regulation in some countries, but it should be noted that most important clients are requiring that. Nowadays, if you don't have as a bread practice, the chance of gaining a mandate, it is zero. It is almost zero. Therefore, what we are seeing in the industry in between two to 5 years, that will be a case, even in emerging markets, because we are seeing that as a strong trend. It is not only coming from global corporate. You are also having local entities. For instance, we have been involved in a mandate with a state-owned one, and they are requiring those best practices. So, therefore, that is a global trend. It is unstoppable and will be coming in the next 2 to 5 years, something that you need to have or you will not compete.
Excellent. Sam?
I think it already is the standard for best-in-class investing. I think, you know, if you think about it from the consideration of all we're talking about at the end of the day, I mean, for us as an institutional investor, is being the best investor that we possibly can. And so considering the full spectrum of risk and opportunities, including sustainability factors, just makes good sense in terms of trying to be that best-in-class investor. And so I would say that standard exists because many global investors also share that view. Is it reflected fully in terms of valuations and pricing? I think that's where we have probably some work to do. And the more that people are focused on how do these impacts translate to, at the end of the day, what is a financial driver and what is impacting value, then the closer I think we'll get to that actually translating. But it is already in some instances for sure.
I absolutely hear you about the valuation part. Tony?
I agree with Sam. I think it's already the global standard. It's hard to imagine an investor who's making judgments on their investments. It doesn't include the quality of the management team in that discussion or the use of proceeds. So I think it's already built in. Maybe if there's a horizon there, it's around optimizing these portfolios around those considerations and then growing them.
Got it.
I think that is a more of a barrier for finance, but I don't think there's a lot of serious argument about where the standard for investment is these days.
Excellent. So I said that we're going to be turning to Q&A. Now would be the time.
Thanks very much. Your last question was a perfect segue. So if sustainability factors are already, core, if you will, to the investing process of large asset managers, what is taking it to the next level look like, and what is the limiting factor between where we are today and where we need to get? Like, is it data? Is it more regulation? Is it what? Yeah.
Is there another question? You want to? We'll take 3 questions and then we'll respond.
Don't worry, you'll get an answer.
Yeah, maybe it's to Sam or others. Have you actually seen the end investors making the trade-off between an impact or a ESG case versus a commercial or a returns case, like a financial case, right? Economics versus impact. Have they actually chosen to trade off, saying, I'm okay to accept lesser returns, provided it's spent in ESG? Because that's at the heart of this, right? That's needs to be answered before it gets to scale.
So I guess my question is, we talked a lot about impact investing. I was wondering if you guys can share a little bit about your thought on speculation opportunities in ESG investing.
Speculation opportunities. So we'll take those 3, and then Rob, I think there's another one down here. In response to your question, I really encourage us all to firmly commit to talking about both and. So there needs to be more regulation, and there needs to be, right? Not either or. So that's my 2 cents for what it's worth. Data, do you want to talk about that?
Again, I agree. Regulation is going to set the standards. It's going to force specific metrics to be disclosed. And that then gives us as a data provider a better playing field to pull in data and have better insights for the practitioners, for the users. That I then think translates into the actual investment process, that those ESG, those climate factors, impact, whatever we want to call it, those are going to be used alongside to our traditional risk factors, our traditional governance practices when we're evaluating companies, when we're evaluating fund managers. So right now, they are 2 separate line items, maybe in that factor list that we'll be evaluating at a portfolio level, but it's now pulling them together to understand, how does this enhance my portfolio? How do we optimize it? I like that verbiage. So I think regulation is going to be the starting point of it, and I think it's going to drive the standardization and these frameworks that we're seeing that will help us as a data provider have more consistent data to then be implemented across the portfolio. To answer the last bit of your question, I think we're seeing that used a lot today from a risk perspective, maybe the companies to avoid, maybe the companies that aren't going to enhance. But I think the next evolution of it is who are going to be the alpha generators, who are going to lead us into And again, from the climate perspective, the low carbon world. Who are the technology and the solution providers that are going to help not only themselves, but their peers and the rest of the world to decarbonize at the fastest rate so we can live in a sustainable environment by the end of the century? I think that's where a lot of alpha generation is going to come from. We're seeing certain investors starting to transition into that mindset, and it's no longer just a risk factor or exclusion. It's now much more integrative. It's now looking for that alpha generation opportunity.
Sam?
I think there is an aspect that is still around capacity building in terms of how do we have full confidence that people know what to do with the information that they are receiving. And so I've often called myself a translator between investment teams and the ESG or sustainability space. And just to help people prioritize, well, this is actually what you need to pay attention to. You already know what is driving the value of this business. Let me help you think through whether this matters or not from a sustainability perspective. And I think the more instinctive that becomes in terms of practitioners like all of you, and that just coming into your analysis process and your investment process, then that will be what then helps it be reflected back in the market in valuations and pricing and all of that.
Juan, do you want to jump in on any of those questions, especially the last one?
Well, regarding the last one, the regulation is important, but what we are seeing in some countries that are lagging the regulation compared to the other world, it is something that all the members of the panel have mentioned. The standard of having ESG analytics into your investment process is something that you need to have, otherwise it is very difficult to move forward. What is the reality in order this to be effective? At some point, I think that most of people are having those type of tools and are trying to generate two things: engagement for the clients, and also in some way trying to, I would say, deliver some alpha. From the perspective of alpha, that is not very clear that alpha has been consistent along the years in the ESG section. But what we are seeing is that there are some key areas, like, for instance, those related with infrastructure, those related with clear tech, those related to water, those related particularly in the latest year to climate change, where alpha has been much more, I would say, consistent in terms of from a statistical standpoint. And we think that a lot is about to come, and those asset managers that are moving faster, those will have, I would say, a higher scope, a broader number of clients, and also broader opportunities in terms of how they can impact the world.
Excellent. Can we have the last question here?
Yes, just one question, kind of building off the concept of when does ESG become a best practice, or is it done everywhere? We've seen in the US some pushback against ESG becoming best practice, with some local governments kind of resisting any ESG consideration. And I think it's an interesting perspective of maybe we have hit some kind of critical mass, but then there's that pushback. But I wanted to hear the panelists' perspective on kind of what they think that impact of that pushback might be, where there's anti-ESG regulation, where certain investors or asset managers are told they're not able to consider these factors, in what ways they might recommend kind of looking at them from an investment perspective while not getting in the way with the, I guess, regulation moving in the opposite direction.
Tony.
Oh, I get the easy question then, do I? Thank you. It's an important question, and maybe just start out by acknowledging the CFA Society's willingness to take on these topics in this climate in the United States at this point. So at FII Institute, we're a big believer in data, right? And we realize that a lot of the priorities and topics of the day are necessarily controversial, right? They are. They're different opinions on that. In the United States right now, the phrase or the term ESG has become quite controversial. It's been politically polarized. It's not as true in other markets. It's not as true in Europe, maybe in the future. Not as true in other places. So it reflects a dynamic in the United States. And that debate needs to play out. and let's play it out with good data. And that's where the FI Institute feels we can play a role. In addition to the work of our think tank, which is doing this original research really on defining these problems, the investment team is partnered to bring lots more data to the table. It's not necessarily that it's new data that was unknown to man. It was data that needed to be analyzed and presented to investors in a way that some of those internal barriers to using the data in decision-making could be lessened, right? So it's adding data to a debate, adding data to a conversation, and hopefully providing to investors an encouraging view of investment opportunity outside of their home markets, outside of Europe and North America. So we're big believers in data, and we welcome the debate and the conversation. At our events, we're, like CFA Institute, holding panels on these topics. We're framing those conversations as debates because we see that as constructive. And for sure, all investors are going to learn from this process, and all investors will be honest that they're, need to improve and that the tools need to improve. So it's not a question of being beyond dialogue and discussion. It's really a point of let's make this about data and move forward in an objective, grounded, and substantive way.
Well, we couldn't have you be the last word on data. So fully agree with you. But Ariel, your perspective, please, on the ESG pushback.
On the ESG pushback, I think a lot of it is perspective. Where we're coming in from ESG pushback is it's a very personal issue to a lot of these states, especially where their entire economy is built on what is considered not climate friendly, not ESG integrated. So it's really coming back to practitioners, to data providers, to make sure that we can educate the entire population on why is this important? How do we move into a just climate transition type of world? I'm not a politician, so I don't have the answers, but I think from Ariel Nicholas's perspective, that's where we really need to get. It's an education issue, and we need to be able to communicate where we're not losing out on returns if we X out energy from a portfolio. It's what does the entire inclusion actually look like? So I'm going to end where I started my comments today. Climate risk, and I would say that even the same is applied for ESG data. It's a systemic risk. We're going to start seeing new regulations and new frameworks come out. We have to get ready for it. We can no longer just sit on the sidelines. We have to have a solution. We have to have answers. Stakeholders are demanding this type of integration. My kind of philosophy around it is that information is power, and the better informed we are, the better decisions that we can make and ultimately battle against climate change. So thank you for being here.
Together. A factor that we haven't discussed up here, but should be taken into consideration, is the youth population. And they universally are impatient with our perspective of it's going to change soon. They have the information 24 hours a day, no matter what geography they're in. And so I look to you guys to be mindful that pace of change matters as much as, and some would say more than, the process by which you take on that change. And with that, thank you all for being such generous panelists, and thank you, CFA, for having us.
Thank you.
What a great panel. Thank you all so much. That was excellent. So we're going to have a 15-minute break, and then Comptroller Brad Lander will be delivering the closing keynote after that. So we'll see you back in 15 minutes. everyone to please take their seats. Please take your seats. My name is Tom Brigandy, and I serve as chair of the board of CFA Society New York. Thank you so much for sticking around for the whole day. Now I have the distinct pleasure of introducing our closing keynote speaker, the Comptroller of New York City, Brad Lander. Comptroller Lander serves as New York City's Chief Financial Officer, in addition to an advisor and a custodian for the city's 5 pension funds, which collectively manage roughly $250 billion. Prior to his current role as Comptroller of New York City, Comptroller Lander served for 12 years in the City Council, where he co-founded the council's Progressive Caucus. Comptroller Lander has strengthened the office of the Comptroller's, his office, efforts to combat climate change, the climate crisis, and we're really honored for him to be here with us today. So please join me in welcoming up to the stage Comptroller Brad Lander.
All right, thank you so much, Tom. It's a delight to be here at the CFA Society. Thank you so much for being part of New York's Climate Week activities, a very busy and bustling time in Midtown right now. My son works not too far from here, and he's like, Dad, I don't know what you got to do something different with this UN General Assembly. No one could get anywhere, though we're delighted to have the president in town. It's especially great to be introduced and welcomed by Tom. Tom was several controllers ago, I guess, got his start as an intern in the New York City Controller's office, which is wonderful. And it's great to have CFA building and strengthening the society of professionals across such a long time now. And really, the world is coming around to the need for higher ethical and environmental standards. And it's great to be doing it together, and really appreciate all the work that all of you do. Grateful to the sponsors as well. MSCI, we work closely with. We just put out our net zero implementation plan, which I'll get to in just a minute. A very detailed plan we put forward in the spring, and of course that includes, scopes 1, 2, and 3 disclosures, which MSCI has been essential to working with us on. So I'm Brad Lander now for about the past year and a half, the New York City Controller. That's the city's chief financial officer and chief accountability officer. And really, in so many ways, the most profound of the duties is managing that now about $260 billion set of pension funds, which is the retirement security of teachers and firefighters and police officers and school crossing guards and nurses in our public hospitals, school secretaries, and on and on. About 750,000 current and future retirees who have pledged their lives to serving our city, and so we make this pledge to them for their retirement security. And of course, they, on the one hand, have that retirement security as a result of the unions that they joined, so they believe in broadly shared prosperity in which workers more broadly can thrive. And it's a very long-term duty, because if you've got someone who's a first-year teacher this year, let's say this is the first year, he or she is a second-grade teacher, by the time they retire, and then for the decades of their retirement, the obligations of the New York City pension funds run out essentially already to the end of the century. So we approach our investment portfolio, on the one hand, of course, as a universal owner. You can't, hide $260 billion or kind of squirrel it away here or there. It is broadly invested across the global economy. There's no approach to decarbonizing our portfolio that isn't decarbonizing the real economy. So, we approach it as a universal owner. We approach it as our obligations run out for decades. So, of course, we're paying attention to this year's performance, but we are also thinking about the performance in decades to come. And if choices get made now that look good this quarter or this year, but that cost us billions of dollars in decades to come, that's a bad financial decision for us, not consistent with fiduciary duty to match our obligations. And then as a public pension fund, not only are we a universal owner with a long-term time horizon, but we're also tied to a public balance sheet, the same balance sheet that holds that set of obligations is the balance sheet that's going to have to pay for protection against rising sea levels or deal with what it'll mean as temperatures rise. Those costs will show up on the very same balance sheet as the pension obligations. And so as a result, our funds have a very strong motivation to have what we believe is the boldest possible effort to ensure that we genuinely reach our net zero goals, that we're part of a partnership in confronting the broader challenges of decarbonization, and that we do it in a way that ensures both the returns in our portfolio and a more broadly shared and inclusive prosperity that works for New York City and far beyond. And so that means we bring our ESG lens in a really serious way. You know, this cannot be some kind of greenwashing. It can be hard to tell bold from BS. There's a backlash, obviously, that I'll talk about in just a minute. But for us, it's just plain common sense and fiduciary duty that we take this role seriously, and that's what we have been doing. So we, earlier this year, as I mentioned, so last year, actually, before I got to the Controller's office, 3 of our 5 funds had voted to set a 2040 net zero target, and they assigned me and my team that implementation plan. And they said, we really want to see it. We want to know it's real. We want to know it's measurable. We want to know we'll be able to track it. We want to be able to show other folks our work. And so we launched our plan in the spring, essentially with sort of 4 steps. One, we had already started taking a couple of years ago, which is we became the first big U.S. public pension fund to divest from fossil fuel reserve owners through a study that started back in 2018 and implementation that took us through last year, 2022. Because we believe that, obviously, that fossil fuel reserve owners, that the stranded asset risks, and in general, created a set of risks that we couldn't simply diversify around. But that does not mean we don't have very bold engagement goals. So those really are where we are focused. So step 1 is target setting and disclosure. So we've got that 2040 target. We set interim targets in scopes 1 and 2, and we started disclosing on scope 3 as well this year. We still have some work to do to set our scope 3 interim targets, but we include scope 3 in our 2040 net zero target. We've started disclosing scope 3 as of now, and we will set scope 3 interim targets next year. And now we're really focused on engagement with our investment managers and with the highest emitting companies in our portfolio. Obviously, you know, we have about 300 external investment managers. Maybe some of them are in this room, you know, from BlackRock, the biggest of them, and State Street, but across a broad array of public markets and private markets asset classes. And the only chance that we have to hit our goals is if they are coming along with us. So we've set a set of standards to have 70% of our financed emissions with science-based targets in scopes 1 and 2 by 2025, and 90% of our financed emissions to have science-based targets for scopes 1, 2, and 3 by 2030, and that's a charge we've given to all of our asset managers against public and across public and private markets. We put a survey out to them earlier this year and have gotten responses from all of them. And now this is when we really kind of roll up our sleeves and get in the work. We've started to look at where our highest financed emissions come from, and who the other investors are in those companies. And I have to say that I'll just use utilities as an example. So that's obviously a good chunk of our highest emitting sector. 90% of the utility companies in our portfolio have made a net zero commitment, made a Paris commitment. Anyone want to guess what percent of those utility companies in our portfolio have science-based targets as of today? Now, it's better than 0, so that's good. It's better than 0. It's even in double digits, but as low in double digits as you can be. 11% of the utilities in our portfolio have science-based targets. So when we talk about kind of filling the global ESG gap, that's like one way of thinking about it. It's great that so many companies, that so many investment firms, whatever, that all of us, after Paris said, great, we're going to set a 1.5 degree aligned commitment. But if only 90% have commitments and 11% have targets, that's the gap we're talking about filling. We focused this past year in our engagement work mostly on U.S. and Canadian banks, another good example of an area where everyone has a Paris commitment, but the International Energy Agency says for a financial institution to have a meaningful Paris commitment, it's time to have a phase-out plan, that you can't be writing new 30-year loans on coal and really even without a plan for phasing down in oil and gas. Not one major U.S. or Canadian bank has a serious plan for how they will do that drawdown. We are making really significant strides on investing in renewables and creating the clean energy economy, and that is great. The Inflation Reduction Act has made it possible for investors to start to put serious capital. There are a lot of challenges to work out, but money is getting to work and prices are coming down, and we're really excited about that. The third step of our plan is scaling up our climate solutions investments. So of course they were at 0, then they were at $2 billion, now they're at $8.5 billion, and we're gonna get them to $50 billion, 14% of our portfolio by 2035. So that work you can see, and it's so encouraging, but by itself, it won't help us hit our targets and stay below 1.5 or even 2 degrees of warming. And you can see this in what's happening because the price of renewables is coming down. They are expanding, but so far, what that looks like is a broader growth in consumption and not yet the beginnings of real decline in fossil fuel emissions. And that, again, is just one other way of thinking about what it looks like to fill the ESG gap. So that's why we took care to make sure we didn't just do kind of a splashy announcement, but really said, here's what we're going to be asking of our managers, here's how we're going to report every year, here's where you can look at our numbers. And one thing that has become much clearer to us in the months since we put the plan out is for the need as asset owners to be doing that work together with some other high ambition asset owners. And that's what we're really focusing on for Climate Week this year, is talking with some of the other big European public pension funds who have been very ambitious on climate as well, because it'd be a lot easier for our asset managers to respond to a questionnaire that we all agree on together. But of course, for folks to feel enough pressure to actually make change, we're going to have to do that work together. So if you are working with, if you have connections with other big public pension funds, or folks on the investment side and insurance companies or philanthropies or universities, we think it's time to take some next steps together as high ambition asset owners. We've put out a way that we're going to do it, but we'll be glad to modify ours a little bit if what it means is we can really build a bigger and broader and more connected team. Let me make 2 more points, and then I'm happy if folks have some questions and we have some time to do that. But I want to talk about 2 things that I think are pretty important here as we face the moment we're in. One is the war on ESG, which is absurd to be talking about, and I'm almost embarrassed as I go around Climate Week, and we've got folks from all around the world who have come here to America, to New York City for the UN General Assembly and all that they're working on, and they're just scratching their heads like they thought that it was long ago settled that climate risk was financial risk, and that there was a broad pathway together that makes sense, from the lens of the global north, the global south, securing a healthy future for the planet and for all of our portfolios, and who I think are stunned to find that, this, right-wing populist culture war has gotten in the way of that. And it's, if you had said to me, a year or 2 ago, there'll be a category that includes critical race theory gas stoves and ESG investing, I think I would have said, like, I think you're standing a little too close to the gas stove. You should step away from it. It is puzzling how we got here, and but it is having a real impact, I think, in part because investment managers are not folks who suited up for politics, right? I spent a career in politics. Sometimes they're shooting at you. You try to get out of the way. You get your brass knuckles out. Obviously, folks who, signed up to be investment managers didn't sign up to be in the middle of a culture war. And some of the red state treasurers and attorneys general have actually done a better job than we have, kind of just teaming up together and making big, bold threats. At the same time, New York City, I was talking to some of the folks at BlackRock, New York City by itself has more money invested at BlackRock, about $60 billion, than pretty much all of the red states combined, because they don't invest heavily in public worker, in their pensions. So it's just a really important moment to be clear about what's going on. This is a very clever political act, trying to make people think that somehow Wall Street is the woke enemy, and that therefore you can run a populist war aiming at it, while mostly what they're doing is the bidding of fossil fuel donors in order to eke a few more years out of fossil fuel profits, but make it seem like a populist war on behalf of working people. Clever, and unfortunately more effective than we can afford for it to be. So I'll just suggest a couple of things. I mean, one is naming it what it is and just being able to be honest about it. Some people can say that more publicly. Other people can be, just kind of having it in their heads, but not taking it more seriously than we need to. I think it's a lot of bluster, but it's not a lot of money. People are not actually pulling a lot of resources out. And even, of course, so many, what were formerly mainstream Republicans and just conservative folks in general know, one, American capital markets are built on the freedom to invest. And that undermining what has made it possible for people to serve as fiduciaries to their beneficiaries and think broadly about what risks are, is just a core underpinning of the American capital markets. And we need to keep that broad coalition moving forward together and not let this distract us. You can change the language a little. You can find other ways to kind of keep moving forward. But that is something that we're going to have to keep doing. And then finally, one thing I think that we can connect the dots between that Climate Week may actually help us with. One thing that's really refreshing as I'm going to the Climate Week meetings is talking to people from the Global South. And of course, they're pushing hard and saying it's wonderful the Inflation Reduction Act exists and that you're putting resources and subsidies in U.S. decarbonization and that you're paying attention to environmental justice issues and what communities are being excluded, who's getting the jobs and whether they're good ones, how you're managing a just transition. We're not doing that enough collectively for the rest of the planet, and I think that's a very useful thing to hear from folks, and obviously as folks prepare for COP to really be pushing for that to happen. That's good for investors as well, because if it's true that the global north countries put more resources in global decarbonization, there'll be a lot more money for people to make investing alongside it once those investments are de-risked. But more broadly, I think it speaks to the point that we really do need, when we say just transition, also show that what we're doing is building an economy that is thriving for working people. Because if they believe what we're talking about is an economy where they'll have less, where folks who work in car factories are going to make less money, where folks who have been in the communities where extractive economies won't have a thriving economy, of course we'll have a populist backlash here and all around the world if we can do better alongside our climate investment and fossil fuel drawdown work to demonstrate how that transition to a clean energy economy secures thriving jobs and good futures for people's communities, we'll have a lot better chance of building the broad coalition that's necessary to sustain that work. So that's why, as part of our ESG work, alongside our ambitious work on climate finance, we are also working consistently on workers' rights, on workers' freedom of association, on making sure that there really is a more thriving and inclusive economy. Our most successful shareholder resolution this past spring was at Starbucks, where we teamed up with a couple of others, and 52% of Starbucks investors voted yes on a resolution saying, we are distressed, essentially, by Starbucks' lack of respect for its workers' freedom of association when they organized to form a union, and we want an independent third-party assessment of the practices there. And we've had a couple of good follow-up meetings with the Starbucks board and management, and there's a lot of work to do, but there's no doubt they heard the message. Apple, for example, when we brought a similar resolution there, said, you know what? You don't need to bring the resolution. We're going to go ahead and do that independent third-party assessment. We recognize we've got work to do throughout our supply chain and workforce, and that's the way that we want to be working together, is just making sure that as we're making the transition to a clean energy economy, we are also doing it in ways that lift up workers, make it broadly able for them to thrive. Again, this brings me back home. You know, it's because of the unions that teachers and firefighters and police officers and school crossing guards have that they're able to have that retirement security in the first place. And when they do, they're able to contribute to the thriving of this great city and be the beneficiaries of a portfolio that's trying to invest broadly to help make sure that we've got a thriving, inclusive, and sustainable future for the whole planet. Thank you very much for listening. And yeah, if we have a few minutes and some questions, I'm delighted to take them. Sure, yeah.
Thank you so much. We're on the live stream, they won't be able to hear you.
I'm usually quite loud, but thank you so much, Controller Landers. Really appreciated the speech. Also really happy to hear that it's not only about the environmental thing, but also the social part. So I have a question. So coming with a European background, there's now also a lot of emphasis on access to healthcare, right? Because the retirement funds, they're also from the healthcare practitioners, the doctors and the nurses that are currently quite burned out. Maybe it's because I'm eager to listen to another speech of yours. What do you think would be the next speech about, or maybe the next week? So now we have Climate Week, maybe the next one was something related to healthcare.
Yeah, well, conveniently, the roundtable I was at this morning with the We Mean Business Coalition, some of the people there are, and I've been pleased with it this week, for whatever reason, the attention to emissions and fossil fuels and the attention to nature have been on sort of separate tracks within the UN space, and it feels like people are trying to get those things a bit more aligned with each other. And from a health perspective, one challenge about mobilizing investments in decarbonization is like, what are like the decarbonization? Why, that sounds like, and at best what we're doing is, it sounds like avoiding catastrophes. But of course, if we're successful in improving air quality, we will improve the health of millions of people around the planet. There are millions of preventable deaths, and that came home to New York City this summer in a way that I think a lot of us were not prepared for. That first day when wildfires in Canada turned our skies orange and black and gave us for a couple of days, some of the worst air quality in the world, was just a real wake-up call, and I think some of us at least tried to say, all right, where are the places in the world where air quality is like that consistently? So there's a really deep health tie-in, and I think maybe bringing together the work of paying attention to emissions and fossil fuel drawdown, but trying to connect it more powerfully to nature, to biodiversity, and especially to health, would be a more inspiring way for people to, be excited about the world we're building. And, that's just a challenge in general. It makes sense why after the pandemic and with a re-elevation of great power competition. They're anxious times. They don't feel as hopeful as we need them to feel. And I think a real good challenge for all of us is to, and look, this is why investment has when you've got a long-term time horizon, you're making investments that offer promise, that offer hope. And the more we can ground that in human health and flourishing, I think the better off we'll be. So thank you for pushing.
Hi, Robert Ball, I'm CIO for the electricians here in New York. Could you speak to how you arrived at the prioritization of your investment program? Because as we look at the things that need to be done in order to achieve net zero, there's a lot of steps. We can invest in transitional, we can invest in renewables, we can invest in hardening the city. How did you get to the priorities in this?
Yeah. And I worry a little. I mean, it's a great question, and a little bit if our plan has a fault, it's that it's kind of an all of the above approach, because we really are. We have a team working very hard on ramping up our investments in renewables and climate solutions, even as we're doing all this engagement work, even as we enacted some divestment and consider some more. So, I mean, the start for us is to look at our financed emissions. I mean, that's really where we try to start. We've got a portfolio, it's invested. Where are our financed emissions? And, there were a lot of them in, before we had divested fossil fuel reserve owners. Although, one point to underline here, and this is why getting good Scope 3 measurement and making sure, and props to California for including these Scope 3 disclosures, 70%, does everyone know that language, Scopes 1, 2, and 3? Mostly, but let me do it real quick, because I do think this is like a lot of what people are talking about, and it's a lot of gobbledygook so Scope 1 emissions are those that come from your own operations. If you got a factory, that's the smoke coming out your smokestack. That's the energy consumed in your processes on site. Scope 2 is the emissions from the electricity that you buy, wherever it is generated. But Scope 3 emissions are upstream and downstream emissions in your supply chain. Like the simplest way to think of that, though, is like if you're an oil company, when the gasoline that is burned in people's cars, that's a giant share of your emissions, but those are Scope 3 emissions. Or if you're a bank, it's not that your bank itself has so much emissions, it's that the loans you're making on fossil fuel extraction are causing it. So 70% of emissions, more or less, are Scope 3 emissions. And so, so that's why we felt it's like important to consider Scopes 1, 2, and 3, and then focus on our, the pieces of our portfolio, the companies in our portfolio that that are responsible for most of our financed emissions. So we think of it by sector. Again, we did the specific piece of divestment from fossil fuel reserve owners. The other big sectors, of course, that are responsible for a lot of emissions are utilities, our construction, our kind of heavy industry. And then we decided to focus on the banking sector, in some ways informed by all the advocacy, because Scope 3 accounting is not standard. Banks don't show up in some versions of accounting, but obviously banks and other financial companies are driving the investment that are making these decisions. So we made the decision to put a lot of our engagement attention this past year there. On the scaling up of renewables side, the good news there is that our asset class heads are getting pitches every week. That was true to some extent before the IRA, but the IRA has really, pushed it more. So I feel like I don't want to say that doesn't need to be a priority. It's just that's a priority that's got a good feedback loop at the moment, where we're getting good pitches, where after doing diligence, we're seeing a lot of investments that we're excited about. And that helps a lot. I mean, talking about the companies that we're investing in, that are making us a good return, that are advancing the transition, helps a lot. And then,
Hi, I'm Sarah Greenberg with MSCI. I wanted to say thank you for the partnership and your comments. I have a second grader in the New York City public schools.
Great.
So, when you talk about this long-term view of, taking care of her teacher and also having a more resilient world, I really appreciate that. I had a question, which is I was hoping to hear a little bit about the differences between your public and private asset classes,
Yeah.
And if there are any investor initiatives that you think are particularly relevant related to the private asset classes.
Yeah. This is a great question. So, and we actually are expanding our private markets investments. Last year, New York State has what's called a basket clause law that has previously limited pension funds to no more than 25% of the portfolio in alternative investments, and it got increased to 35%, so we have a little more room there. But it really does require some different thinking. When you say to a private equity manager that generally holds their companies for 7 years, what's your 2050 net zero plan? They're like, I haven't bought the companies I'm going to sell before then. And so we did engage with folks to say, what's the best way we could do that? So that's where we came to science-based targets. What we are asking, what we've essentially said to all our managers in this survey is like, here are our plans. Here is the ways that we're thinking about it. We want to hear how you're approaching it. But what we're talking about with our private markets managers is saying, we want a commitment from you that you'll implement science-based targets in any company that you acquire that doesn't have them, so that you will set them on that path as part of your acquisition. And mostly so far, I think people are finding that, we'll see. I mean, we're in the process, so we have it's next year that we are requiring folks to show their work to us. But so that's what what we're saying on the public market side is essentially what I mentioned. We want 70% of our financed emissions with Scope 1 and 2 science-based targets by 2025, and Scopes 1, 2, and 3, 90% of our financed emissions. And of course, on the public market side, the share of our portfolio that BlackRock and State Street manage is large, so we're in extra dialogue with them. On the private market side, we've said we're open to other ways of thinking about it, but one that makes sense to us is a commitment to set science-based targets for every company that you buy and set them on that path. And if they're already there, great. I will say a disproportionate share of the climate solutions investments we're making are in private markets. And I guess one more thing I forgot to mention. When we did our fossil fuel reserve owner divestment, it was only in public markets in step one. We have now also put an exclusion of upstream fossil fuels into our private markets investments as well. But this is an area where we're learning, and when I say we're looking to be talking to other asset owners, I think if, like there's the ILPA questionnaire we all use, having something like that for the implementation of your net zero plan, an aligned questionnaire that a lot of us are using that is consistent with with the more ambitious goals. One, I think would actually just be helpful to the managers rather than each of us asking for it in our own different ways. And two, if we get it right, we'll have a lot better chance of pulling people in that direction. Thank you. Yeah. Oh, I'm sorry. I'm not the chooser of the, I pretend to choose, but he's okay.
Yeah, hi, thank you. Gabriel Toomey, I'm one of the sponsors and the CEO of Responsible Alpha. Thank you for being here today. Sorry I couldn't be here earlier. I was being interviewed on television about net zero because we've been recently sued like everybody else by the 22 state attorney generals.
Yes.
At first I was nervous. I was like, oh my God, I should be scared. I talked to my wife. I'm like, no, I should be proud.
Here, here.
We were only 18 months old. You're like, okay. So what advice do you give a small firm like ours? Mike and Stephen are here, raise your hands. But how do we help you? How do we help move this industry forward? We can carry that weight. We can be out in front and center. We can hold the net zero logo and the initiative full and center. No one's coming after me. I live in Austria. What are they going to do? Tell us what to do. How can we help? Thank you.
Yeah, well, you are. I mean, you gotta. What's great. That's great to hear. Thank you for being courageous about it, for doing the television interviews. For taking that lawsuit as a badge of pride. And I do feel like this is where those folks who are in a position to take some more different kinds of risks need to do so. I'll give one example in how we think about it. One thing we definitely don't have is antitrust risk, right? I don't have customers, so asset owners just don't have to worry about an antitrust lawsuit. So we've got a responsibility to step out and be a little bolder. And then if our asset managers are responding to our questionnaire from their customers, that may be a little easier for them than collaborating and setting standards amongst themselves. So yeah, I mean, look, I think there is more strength in the ecosystem that we have. Partly it's going to generate a lot more value in the next decade. So just financially, what they're fighting is a rearguard battle to eke a little more profit out of fossil fuels based on people's anxieties and resentments, and they're effective at channeling them, but doesn't have nearly as much power as forward-looking, hopeful, generative investment. So I think this is a good moment to be standing up, to be creating things, to be building value together, and that's why I'm here, and grateful you are too.
You said you're seeing more opportunities that are basically in the place you're looking for them, and so that seems natural. And the irony of Texas is that it's the most solar and wind in the country, and it's being built. So ignore your television set. And is that the type of thing that you're seeing? And the part two is your partner. It's really the same question. Mubadala bought a Texas gas producer, and in 6 months cut the methane 53%. So I know you divested, but that ironically puts the math back on the other side. Is that?
Well, I'll say a couple of things here. I mean,
what you see.
Yes. I mean, I asked the team to put together kind of some of the investments we're making, and quite a couple of them are in Texas. So yes, I mean, we're not, we're enthusiastic for those kinds of investments, and it's a real array. Of course, that's EV charging scale up, and it's solar and wind investments, and and there, and we have some. I mean, we have a debate about how to count some of the biogas investments, but we're seeing a lot of different things. So. And I think that's great. I really do feel enthusiastic about it. I mean, two caveats there. One I mentioned, which is I'm a big IRA enthusiast, but it's a big planet. And it's not that the IRA can do for the world what it's doing for the U.S., but something has to do for the world what the IRA is doing for the United States. Or, like if we know it takes subsidy to prompt the transition alongside investment capital, it'd be especially surprising if that weren't true in places with a lot less. So that's not on, that does need to come from global governance. Those need, the kind of de-risking money, the subsidy dollars, the tax breaks that are coming from the IRA here. Something's got to do that in global space, and that's just for all of us to keep the pressure up on. We can't do that with capital that's got a fiduciary obligations. And then I guess what I'll just say on divestment, which, yeah. So I mean, and we're looking for it and happy to engage in it. I like that. One nice side benefit. I think for a lot of time, it was framed as though engagement and divestment were like different strategies at odds with each other. To me, they go very clearly together. Most of what we want to do, 2% of our portfolio is fossil fuel reserve owners, so 98% of our portfolio is not, and we're only going to succeed if what we see across that portfolio is real-world decarbonization through collective engagement and transition. I'll be excited when the first company gets to 51%. You know, we said it's 51% of your revenues from burning fossil fuels. So the first one to get to 51% with diversified revenues that comes back, we will be so happy to put our resources back in there. I feel like it gives us a little more strength as we do engagement with our high emissions utilities and construction companies to say, look, we would like to see science-based targets and keep investing and help you make transition. But there will come a point where if you don't do that, you know, you've seen we're willing to pull our capital. But to me, that is a, you know, kind of a partnership. Yeah, great. Okay, thank you all very much. Really an honor to be with you. Have a great rest of your climate week. Thank you.
All right. Let the picture happen. Yeah. We'll let them hurry up with the picture. Thank you, Comptroller Lander, for your remarks today and your stewardship of the pension funds. My name is Antonio Rodriguez, and I am the volunteer with the Asset Owner Series with the CFA Society New York. And just wanted to say it's always a pleasure to see such well-attended events, so thank you all. Before we close, there are quite a few people and organizations that we need to thank. First, thank you to our sponsors, Platinum sponsor MSCI, our Silver sponsor S&P Global, and our supporting sponsor Responsible Alpha. Thank you to Comptroller Lander again for his remarks and stewardship, and all of our speakers, panelists, and moderators for your thoughts, your comments, and insights today. Thank you to our chair, Tom Burgandy, for your continued leadership, and all of the staff of the CFA Society New York for their tireless work on this and all of our events. Finally, all of you today for your attendance, your questions, your participation, and your enthusiasm. This is such an important topic, and your enthusiasm really helps drive us forward. Please stay for the reception, and we look forward to seeing you at future CFA Society New York events. Have a wonderful rest of your day and a wonderful rest of your climate week. The reception's over there.